50 minutes away. Looking forward to catching up with him. Equity futures up by a third of 1% from New York this Monday morning. Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Brazil's President Luiz Inácio Lula da Silva is vowing to prosecute rioters who stormed the country's top government institutions on Sunday. The insurrection by thousands of supporters of ex-President Jair Bolsonaro follows months of protests since the conservative leader lost to Lula by a razor-thin margin in an election runoff. Lula is calling for federal intervention. On Capitol Hill, new House Speaker Kevin McCarthy is rallying Republicans with promises to cut spending and strengthen border security. Still, in order to win the position, McCarthy had to give up more leverage to the party's right wing. He promised a rule change that would allow a single lawmaker to call for a vote to oust the speaker. Russian President Vladimir Putin's plan to squeeze Europe by weaponizing energy looks to be fizzling. Mild weather and efforts to reduce demand are helping. Gas reserves are still nearly full and prices have fallen to pre-war levels. Europe is likely already through the worst of the energy crisis. Richard Branson's Virgin Orbit says it's on track for Britain's first ever space launch tonight. The takeoff of a modified Boeing 747 jetliner with a rocket under its wing is planned between 9:40 and 11 p.m. The mission will deploy 9 satellites for a range of customers. And Apple exported more than $2.5 billion of iPhones from India from April to December. And that's almost twice the previous fiscal year's total. And it underscores how Apple is accelerating a shift away from China. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg.
It's not that the Fed wants fewer jobs. What they want is lower wage growth. More because they're worried about persistent inflation. 70 to 80% of all of the costs of our production in the U.S. is related to jobs and wages. And so if that's going up really fast, that can make it very difficult for inflation to come down.
Softer wage growth on Friday, throwing a sub-50 ISM, and apparently bad news is good news for this equity market. That was Randy Krosner, the former Federal Reserve governor. Your equity market building on the gains of Friday on the S&P 500, up by a third of 1%. You will hear from Chairman Powell tomorrow. You'll get some CPI data on Thursday. And then Friday, it's all about the banks with JP Morgan kicking off bank earnings on Wall Street. Goldman Sachs, the latest from them, planning to cut more than 3,000 jobs this week, according to our reporting. 1/3 in its core trading and banking units. Bloomberg's Shanali Basak spoke to the Goldman CEO, David Solomon, just last month.
Uncertain time, given we're changing monetary and economic conditions very, very quickly. And that's certainly having an impact to slowing down economic activity. And so if you're running a big financial services firm, I think you have to assume that we have some bumpy times ahead.
TK, bumpy times right now.
Right now, no question about it. And there's an immense divide between what they're doing and Jeffries and the rest and what we're seeing from the major banks that they're always trying to compare themselves to.
And ultimately, how much of this we're going to see, Tom, in the quarters ahead?
Well, yeah, we're going to dive into it with the earnings season. It starts Friday, right, John? After inflation Thursday.
With JP Morgan, yeah. And then I think
Friday.
Goldman next Tuesday.
Yeah, we're going to be a lot smarter into Wednesday, Thursday of next week on this. But, John, what I would really, really emphasize is how fluid the situation is. And the heart of it is, who do you want to be? Shanali Basak joins us here on this day of Goldman Sachs layoffs. Is the heart of the matter that the management of Goldman Sachs wants to be more like Bank of America and JP Morgan? They're 300 basis points per year behind them over the last decade.
I think what's difficult to ask about a question like that is it implied that big move into consumer banking. But from the beginning, there have been a lot of doubts about how big they could really get in that kind of a business. The idea was for this moment to really be a stable part of the bank, a stable force, as a lot of those other businesses, trading, banking, were very cyclical. The thing is, it didn't get to scale very quickly, right. And now they're on track to lose about $2 billion in the consumer unit.
Let's move forward to William S. Cohen's great book on Goldman Sachs. Everything happens at Three Guys, Five Guys, whatever the breakfast place is on Madison Avenue. They're going to go in there to a booth at Three Guys on Madison Avenue, and they're going to sit down and say, am I right? We have a $2 billion loss in Goldman Sachs banking?
Listen, a few things.
That conversation's never happened at Goldman Sachs, right?
Yeah, of course not, because they didn't have this unit just 5 years ago, or really to the scale at 5 years ago. So at the beginning, I remember having conversations inside of Goldman, and so much of the purpose was to diversify, but also lower the cost of funding for Goldman Sachs. But the cost to do that, Marcus is still giving you 3.35 on a high yield savings account. Most of the large banks have not budged among 0.01%. So it costs a lot to get customers. And there was some actually really great reporting in Semaphore as well from Liz Hoffman that showed you it wasn't all just the decisions they made. They hit a lot of hiccups along the way. One interesting one being issue with the vendor who was also an investment banking client. So I thought that was a very interesting tension as Goldman expands. How do they expand not just to meet the consumer, but to keep their existing client happy?
Yeah, but how much of these cuts really are, as John was talking about earlier, just sort of delayed attrition, delayed culling of the ranks that we didn't see during the pandemic era?
A lot of that is definitely true, because in the pandemic, they were making so much money. And by the way, even this coming year, they're expected, even with profits really falling off, they're expected to post their second best ever year by revenue. So I think we really have to quickly change this discussion, because yes, 3,200 people is a lot of people. It is not 2008 style cuts, but more importantly, with them cutting 3,200, Morgan Stanley cutting another 1,000, most other banks starting to cut by the hundreds, you have to start to ask where the capacity comes from, because there's nowhere to hire out of that firing.
Well, but there's also this issue right now of all of the people who are getting laid off. Will this bank be smaller than it was in 2018? With some of the tech companies, there's a real question of where we're retrenching to. What is the level we're retrenching to, or is it just sort of paring around the edges to a much bigger footprint than they had pre-pandemic?
You know, with 3,200 people, I don't want to say that's a small number by any means, but to the point you're making, you don't get back to 2018. They've made acquisitions in that time frame. The headcount has grown very dramatically. They've hired a lot of people that are not just at the very top level of senior banker here, because they had so much work to do. If you remember, even the young people, right, that brought up the cost base by a base salary rising per banker, right. $50,000 a pop, right? So you already had fixed costs rising, and revenue is on the precipice of declining.
John and I were at Three Guys having breakfast, trying to recapitulate what Goldman Sachs did there years ago with all their important conversations. The waiter came up to us and whispered in my ear, SPACs? Okay, is this just unloading the failed equity efforts of the last 24 months?
Can I mention something else too? You know, you have this exuberance really getting out of the system. There are tons of people that are excited about that. Let's be honest about this.
Excited about what?
The fact that the SPAC wave is over, the crypto boom is done, right? This idea that maybe you might see some distressed opportunities come back. You might have some interesting credit opportunities come back. So the client base starts to shift also.
You touched on the work environment. Can we sit on that for a moment? I think we all remember that story. Was it the first-year analyst that came out with the PowerPoint presentation?
Exactly. This was a couple years ago.
Do you think there's going to be some grit that returns to Wall Street? Because I think a lot of people that work on Wall Street in the last couple of years think that things have got a little bit too soft.
Yeah.
Maybe a little bit too soft. Do you think a bit of grit returns?
100% the grit returns. You know, I was talking to some younger bankers over the last week or so, and
I'm shocked.
yeah, you know, at this point, I'm a decade older. So, but, you know, the conversation was when they talked to their friends on Wall Street, some of them don't want to stay in the business. They're afraid, right? Some of them are the most excited they've ever been in their career because they realize this is the time that might make their career if you can get through this cycle. You also start to get, this is the time where you're not talking to the banks for money. You're talking about to the private equity guys for money. Those are the guys that are still lending, and they have so much dry powder on the sidelines.
To everybody, this is important. Why is Wall Street any different than any other sector? Money isn't free anymore.
Well, I think the fact
that's
that
the heart of the matter.
So I think the fact that tech is also in a bit of trouble right now changes the game on Wall Street. I think for the
agree.
last decade or so, the hiring managers at these big banks felt like they were competing with what was happening in big tech. And I think the reason why the analyst community had so much leverage, the first-year analysts straight out of college, is because these banks couldn't offer them the upside that existed elsewhere. That's a massive, massive change. And the fact that you get the return of discipline, Tom, 5% interest rates, putting tech in trouble, I think changes the game on the street as well.
You also have to ask about the consumer, too, because at the point about Bank of America, JP Morgan, they hit a lot of trouble last year in the face of higher interest rates. This is supposed to be their time. So if you look at the rest of this year, remember, consumers still have stimulus. They still have the student loan moratorium. That's hundreds of dollars a month that they are not paying, that they can use to pay down credit card debt and other things.
Got to be pretty bold to be the first-year analyst that does that PowerPoint presentation at the moment, haven't you, Tom? Can you imagine that?
You might be gone by now.
I don't know if that's a great idea.
Well, I imagine they're in the office, which is also different. I imagine they're all in the office,
You
and
think?
nobody is in their pajamas anymore. And everybody is going to be wearing
They're wearing
suits.
suits and ties.
They might get away with the Lululemon on the way to the gym, but then on the way out, they better suit
You
up.
mentioned
Reporting by
Okay,
Shonali
honestly.
Bassett.
And that was the perfect segue.
Exactly.
There. Shonali, thank you. Shonali Bassett there with the latest. Lisa, the latest out of Lulu. Margin pressure.
Yeah, exactly. And you're seeing those shares plunging more than 9% in pre-market trading because they do expect margin contraction after so many years of expansion. This is now shares lower than 11%, moving very quickly. Now seeing net revenue at $2.6 to $2.7 billion versus the estimate, which was about the same thing, but still earnings per share coming in much lighter. And again, how much is this a story that is going to be a feature throughout all of the retail sector? Nike and Under Armour are also lower.
Yeah, you mentioned
after
Nike,
results.
Tom. Nike down by about 1.5% off the back of some of this.
Yeah, well, it's going to happen. And I mean, this is into the earnings season that Mike Wilson and frankly everybody else is talking about. Now, I go back to Stuart Kaiser. You mentioned Schumacher coming up. These guys, their basic theme is it's going to be very selective. And whether you're talking economic analysis or investment analysis, the choice set seems to be shrinking down rapidly.
It's interesting, though, especially in light of what Shonali was talking about. The company now expects that it will further leverage selling, general, and administration expenses. And their basic, idea here, where are they going to cut costs? Are we going to see the labor market being affected by margin compression as a way to address some of the potential pitfalls in profits?
We're getting slammed on Lulu. Nike down by about a little more than 1%. No real drama in that stock. I think you said Under Armour was down as well.
Yep.
At least from the pre-market. So retail, sports retail, getting hammered at the moment if you are Lululemon, TK.
Is the heart of this like at Lululemon? I've got the license to train jogger. After you've bought 4 pair of those, do you need to buy a 5th pair?
You want some Lulu?
Yeah, of course I do.
Do you?
The ones with the
I've got some
pockets, the stretch
chisel.
pants with the pockets? and
No,
the
I don't
thighs
have.
to put your phone?
No. We decided that was vetoed. Vetville said he wouldn't walk with me with that. But I do have the license.
I wouldn't
the
walk with you
license to
either.
train
I've got to be
jogger.
honest with you. I wouldn't walk with you either. Alessio De Longis, the Senior Portfolio Manager at Invesco Investment
Shonali's just
Solutions.
shaking her head. This is
Joining us in just a
brand
moment.
destruction for Shonali.
Equities up a third of 1%. Thank you for Shonali. It's good to see you. From New York, this is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. recording, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's Renewable Assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
The Fed is going to be late.
I think that the Fed is imposing a severe slowing on the economy.
They'll pause if inflation is declining, but they won't be able to if they're not achieving their inflation objectives.
They're looking for slower inflation, but still nowhere near target.
The Fed, as well as every other central bank in the world, got it wrong. They said, oh, transitory, transitory, transitory.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This week, how much more do you want? CPI, Chairman Powell, earnings season begins. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures adding to Friday's gains. TK, the S&P, up a third of 1%.
It's a nice lift, and it comes off the big lift that we saw on Friday. I would note also, John, I think critically off China reopening. Oil up 3% gets my attention. Brent crude, $81 a barrel.
Big moves we saw in the equity market on Friday. Big moves we saw in the bond market as well. Yields lower, a whole lot lower. We've got to tease out the economic data, what on earth it means at the moment, Bramo, and spare a thought for Chairman Powell, who's got to respond to this tomorrow.
Will it matter? Will anything he say actually have credibility in markets? Because a lot of the Fed officials have been saying the same thing. They've got more work to do, and this market is saying, we're seeing soft landing, we're seeing this perfect ending here with two data prints that might suggest that things aren't as strong as previously
Do you think those sub-50 ISMs scream soft landing?
people are saying you need to see that softness in services. And the reason why people say that as a soft landing and not a hard landing is because wages are coming off, but the numbers on the headline number are still strong. So people are talking about a soft landing. Again, does this matter? It is one data print. How much does this actually indicate what's coming? Although you are seeing earnings starting to trickle out, perhaps more in the Mike Wilson.
That's the downside risk. Let's talk about the upside risk. China reopening. The rip we've seen in EM equities. Emerging market equities up more than 20% since the lows of October, Tom. Big moves we're seeing here.
I'm going to go back to Blinder's essay in the Wall Street Journal, the gentleman from Princeton, the former vice chairman, where he says, look, here's the reality. China's reopening, Pacific Rim with a bid. Johnny mentioned ADXY with a nice lift there. Lori Calvasina in the last hour talking up. We've got a killer guest, must listen, must watch for Global Wall Street coming up. And this is on the optimism. This year will not just be the United States.
Mike Schumacher of Wells Fargo coming up in about 28 minutes. Alessio De Longis of Invesco coming up very, very shortly. Alessio a month ago, constructive risk.
Nailed it.
And DM and International specifically. We'll pick up on that in a moment. Equity futures right now up a third of 1% on the S&P 500. Just to whip through the price action briefly. Yields a little bit higher by 3 or 4 basis points on a 10-year. 359.48. Euro dollar, Tom, approaching 107 here. 106.85.
Dollar dynamics with the yuan really there, 6.78, distant from 7 yuan per dollar. The renminbi showing strong China strength. And again, I'm going to take that. Jay Pulaski, who I know is, Jay won't get up first, folks. Full disclosure, he's got to slide in with Pharaoh in the 9 o'clock midday hour.
I haven't spoken to Jay for months.
Well, get him on because I think he's been right. And he shouldn't be punished on the when of it. He couldn't predict a China lockdown. It's over.
And now we're ripping.
I priced.
Jay's getting what he wanted.
I priced business class to Shanghai today.
How much?
$34,000.
Are you kidding?
That's for one seat.
Are you kidding?
$34,000, one seat, nonstop.
Wow. Seriously, what airline?
This is United. Full disclosure, I've got family in China, so we want to get over there. But the answer is I'm going to monitor that and watch it come down to something intelligent.
Can you meet halfway? Can you meet somewhere else?
It's under collegial discussion. We brought in McKinsey to handle those negotiations within the family.
Well, if you want some consulting, I'm available.
Okay, thank you.
Okay, Lisa, we've worked that out.
Yeah, you haven't worked out the fee. At least that will be, I guess, the negotiation in the break as to your consulting services. Today, as far as meeting in the middle, central bank speak includes both Atlanta Fed President Raphael Bostic at 12:30 p.m. And on the other side of the Atlantic, Bank of England Chief Economist Hugh Pill at 5:30 p.m., although he will be speaking in New York. Also, it is notable that Austin Goolsbee becomes the president of the Chicago Federal Reserve. How much do we get a sense of them pushing back against the excitement around a soft landing type of scenario, or do they lean into it? Do we get any signal that perhaps they're excited and they're going to welcome this to possibly slow down the pace of rate hikes and the end result? Today, we also get the Three Amigos Summit. That would be Joe Biden of the U.S., Andrés Manuel López Obrador of Mexico, and Canada's Prime Minister Justin Trudeau, all joining together in Mexico City for this North American Leaders Summit. A lot of issues on the table, very much, Tom, as you've been mentioning, the immigration question around the United States, but also at a time when so many people are talking about moving manufacturing to local areas. How much do we get a sense of some meat behind that versus some of the contradictions that people have with where those trade policies should go? And aftermarket kicking off that earnings season for the banking industry. Jefferies expected to release the fourth quarter results. Question mark, especially ahead of JP Morgan releasing on Friday, along with a host of the other major banks. How much do we get a sense of the cutbacks that we saw in Goldman that we were just talking about with Shanali versus where the profits are going to be? Where are those opportunities as you do start to get more dislocations and potentially more distress, John?
What a tough 12 months for BofA, looking at those numbers there. Unreal. Bremo, thank you. Joining us now is Alessio De Longis, Senior Portfolio Manager at Invesco Investment Solutions. Alessio, wonderful to catch up with you, buddy, as always. They say there is a bull market somewhere always. Alessio, right now, it's in emerging markets. Can that continue?
Yeah, I think it can continue. Emerging markets is seeing now, both equity and fixed income are seeing a great setup due to primarily 2 or 3 major forces. The China reopening, which we may debate whether it is a global scale event or not, but it's certainly an EM-wide relevant event. You have very attractive valuations and a dollar cycle that has finally turned, coupled with the peak in interest rates. So we all know it's the best time to be overweight emerging markets, both equity and fixed income, when when the Fed is close to the end of its tightening cycle and signaling a pause, when the dollar is depreciating and extremely expensive, and in this particular case, the China reopening trade. So the constellation is very supportive for an EM performance over the foreseeable future.
You know, Alessio, I know you're going to tell me that it varies client to client, but the bottom line at Invesco is if you're going to make the DeLongest call and go into international, do you pile in or do you just go in with a measured amount? How big is the conviction?
From a tactical standpoint, the conviction and relative to the United States, the conviction is very high. Now, from a total return perspective, the conviction has to be mitigated. Let's not forget the yield curve is inverted by 100 basis points. The recession is not a question of if, it's a question of when. So when that recession really comes, but it could be 12 months away or more, when that recession comes, the high beta markets, Tom, which is, I believe, the nature of your question, the high beta markets such as international equities and emerging markets will suffer. We in that scenario, we will see markets with a bias towards value, a smaller capitalization, tend to underperform, and the dollar will shine again. But my point is, from a tactical standpoint, sitting on bearish defensive trades for too long, it's a very expensive proposition. So the way we position it to our investors is look at finally diversify into EM and into international equities, because we know there is a absolutely massive home bias in favor of U.S. equities, which have outperformed now for 15 years.
So, Alessio, how much of this long international equities hinges on the weather, and the weather in Europe, and on the situation with respect to China, and not seeing necessarily a dramatic increase in their imports of natural gas?
Well, that's a good question. It highlights a little bit maybe the tactical nature of the call. I wouldn't call it necessarily too much dependent on the weather. I see exactly where you're going with this. The pricing driven by market participants was extremely bearish. What we're beginning to see, though, is actually in the economic data, consumer confidence surveys across the board are rising from deep recessionary levels, and they're bouncing back up. So to your point, the weather expectations, so to speak, the energy crisis may have driven us to recessionary or depression-like consumer sentiment. I think the skew of the risk, the downside here is more mitigated. The reality is that Europe is seeing the benefits of, Europe and the UK are seeing the benefits of extremely cheap currency valuations, which on the margin begin to feed very well into future earnings growth. So not so much dependent on the weather, but rather the fact that the cycle of bearish sentiment in Europe seems to run out of new fuel.
Alessio, you were constructive on the international story a number of months ago, and I was there questioning you about it, and it's delivered in a big way in the last couple of months, that's for sure. Alessio DeLongest there. I'm Invesco. Alessio, thank you. Also questioning this story is Bank of America and Sebastian Radler, who said this just last week, and I'll read you the quote verbatim. We think the next big story for markets will be a sharp loss of growth momentum in response to aggressive monetary tightening. The team at BofA, on that side of the business anyway, went on to say, this is not yet priced, with markets buoyed. You say buoyed, right? Buoyed?
Yeah.
Buoyed? Buoyed makes sense.
You say buoyed?
We say buoyed.
You say buoyed?
Buoyed makes no sense at all.
No,
by strong activity on easing supply issues,
But it
fading
sounds
gas
better.
prices, and China reopening. I think we lost the point somewhere in all of that. Anyway, you get the picture that maybe the China reopening story for Europe is a bit of a head fake, because what we're about to confront is a real deceleration in the economy.
Which I think is the flip side of the tactical issue that we just heard about from Alessio DeLongest. This question of, okay, perhaps this is a tactical issue of things being oversold and over pessimistic, but it doesn't necessarily mean the all clear is being signaled that suddenly you're going to see some sort of rampant growth.
Certainly the dominant force at the moment, Tom, has been that reopening story in China, without a doubt. And our latest
lost my train
reporting,
of thought.
our
I'm
latest
trying to
reporting
process
suggesting they will be
Boyd.
looking at wider budget deficits. I know you want to continue this.
But that's actually really interesting, because suddenly you're getting both prongs, China reopening and stimulus, basically a greater allowance
Critical
to
point.
increase some of
Critical
the deficit
point.
spending in order to buoy the economy.
And what buoyed me this morning was seeing the
As soon as I
fiscal
saw that word,
stimulus
as soon as I saw
headlines.
it, I
You knew
knew.
it was over.
Let's buoy ourselves by talk here about the translation moment. I think it's Premier League football this weekend. I can't tell. You got so many different leagues going on over there. And I'm told there'll be a derby of some
There's a
type.
North London derby this weekend.
It's a derby or derby. We're buoyed by the conversation.
You know, recently you've
over the
watched
derby or the
more
derby.
football than I have recently. After the World Cup, I'm just like, I'm so out of sync with a World Cup in the middle of the season.
Yes,
that I'm
and
just
for you
kind
it
of
must
like,
be, yes,
shouldn't
for
there
you
be a
it must
summer
be
break
difficult.
now? I'm not ready to get back into it quite.
No, I've
the
heard
same
of some
way.
other people is, well, my issue is I'm getting tackled on the street by Tots supporters.
I saw that. They messaged me.
You know, there's like
the gentleman from PwC.
Well, that's just not one guy. There's a lot of people. They come by. They're wearing Tots swag and that.
And what do you say about it?
I say it's a derby, and they say no, it's a derby because they're buoyed.
Do you have an official position on whether Antonio Conte should stay?
I am not smart enough to know if he should stay, but aren't we there now? But isn't it a big debate right now,
When
John?
does he start calling them the Spurs?
It's my favourite with Tom. Whatever the subject, football, markets, the economy, politics, I won't give you my opinion, but...
Right, exactly. I'm not an expert.
And then he proceeds to give you his
I'm not
opinion.
informed enough.
Okay, but from New York, this is Bloomberg.
I don't know.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The capital of Brazil is recovering from an insurrection by thousands of supporters of former President Jair Bolsonaro. Rioters ransacked Congress, the presidential palace, and the top court in Brasilia on Sunday. It took hours for security forces to regain control. New President Luiz Inácio Lula da Silva is vowing to prosecute the rioters. In El Paso, Texas, a confrontation between President Biden and Governor Greg Abbott. Abbott handed the president a letter demanding that he act immediately to stop unauthorized immigration. Since President Biden took office, the U.S. has experienced a large increase of migrants trying to cross the southwest border. And in China, China is trying to change the narrative on nationwide protests prompted President Xi Jinping to abandon the COVID-0 policy. Now, according to a timeline published by the official news agency, the leadership started relaxing COVID restrictions before the protests began. On Sunday, China reopened borders that were largely shut for almost 3 years. The European Central Bank is strengthening the case for more interest rate hikes. It predicts that wage growth, a key indicator of where inflation is headed, will be very strong in the coming months. The ECB says that reflects robust labor markets that haven't been substantially affected by the slowing of the economy. And Goldman Sachs set for one of its biggest rounds of job cuts ever. Bloomberg's learned that Goldman is expected to eliminate about 3,200 jobs starting midweek. More than a third of those will likely be within its core trading and banking units. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Kevin McCarthy and I have had some positive, forward-looking conversations over the last few weeks. And I'm hopeful that we'll be able to build upon those conversations to do the right thing for the American people. Clearly, we are going to have strong disagreements at times, but we can agree to disagree without being disagreeable. That is what I believe the American people would like to see.
Did we just get a chaotic appetizer for the year ahead down in Congress? That right there was the House Democratic leader, Hakeem Jeffries, speaking to NBC over the weekend. Live from New York City, good morning to you. Your equity market building on the gains of Friday, up by 0.4% on the S&P 500. Yields are higher by 3 basis points on a 10-year, 359.11. Yields were aggressively lower in Friday's session as wage growth came in a bit softer, and the ISM services indicator came in sub-50 in contraction territory. Your next big stop for this market, of course, is Chairman Powell tomorrow. Tom, we hear from him, I believe, at 9 a.m. Eastern time. Then it's CPI Thursday, just a couple of days away.
Yeah, CPI Thursday to me is a huge deal. And then we launch, John, right into the earnings on Friday and into Monday, yeah. I believe, as well. So it's going to be a real backloaded end of the week. We're going to stop the show right now, and we're going to talk about Greg Valliere of New Hampshire, which is the drug entry capital of the United States of America at one point. And he and I would describe what it did to his New Hampshire. It is unmentioned among the three amigos in Mexico City. Our Anne-Marie Horton is there, always up to speed. She's our Bloomberg Washington correspondent. Anne-Marie, I think the whole conversation is sanitized with a huge arrest 3 or 4 days ago on the opium battle. I take real issue with opioids, fentanyl, all the other jargon that's soft-pedaled. All this is about is heroin. What are these three guys going to do about the drug tragedy of North America?
Well, Tom, as you just alluded to, this comes on the heels of the Mexican authorities arresting El Chapo's son. This was really a huge coup for the U.S. It's something they wanted to be seen. And there's been a lot of pressure on the Mexican government, on AMLO, from the U.S. administration, to crack down on these drug cartels. And one of the biggest drugs that is trafficked by this individual and some of these Mexican cartels is fentanyl. And that is why you have a huge amount of individuals paying close attention to the amount of narcotics, because not just this is highly addictive, but this is lethal. And the number of individuals between 18 and 50-year-olds dying from fentanyl is rising. And you have a senator, Tom, from West Virginia, Shelley Moore Caputo, writing over the weekend an op-ed because she said, even though I'm in West Virginia, why I care so much about the border is the increase in fentanyl, what that means for her communities.
You know, John Farrell's talked about China being a bipartisan issue. Let me suggest that opium or heroin is a bipartisan issue. What are we going to do about it?
Well, it is a bipartisan issue, and I think when you talk to both sides of the aisle, they want to see more funding when it comes to the drug enforcers, and also the fact that, especially when you talk to and you see some of the plans the administration has wanted to put forward, is more resources and funding to these local governments, whether it's Mexico or other areas in South America, so that they are investing in the fact that potentially more people are not going into the jobs of supporting or being part of the cartel. Because when you saw the kidnapping of El Chapo's son, you can almost see that these are in themselves military states within a country.
Anne-Marie, the focus for you, I know, is in Mexico City and for perhaps Joe Biden, but for everybody else, people want to understand what the aftermath is from the C-SPAN ratings bonanza, which has been the negotiations over the Speaker of the House. There is a question of what the ramifications are for some of the concessions that we saw from Kevin McCarthy in order to get to become the House Speaker. What is the sort of projection of what this gridlock will look like, the internecine gridlock among Republicans?
Well, you could even talk to Republicans like Representative Gonzalez, who on Face the Nation over the weekend talked about the fact that C-SPAN ratings is going to continue. Even little procedural, I would call maybe the plumbing of Congress, the plumbing of democracy, electing a speaker. They're going to have a vote on the House rules. All of this usually just evaporates from the headlines and is pretty much American public ignores it. Now, this is prime time
days spent on this, and the next big fight, I mean, we should note they're meeting at 10, some of these GOP leaders, to discuss who's going to get top positions on committees and who is also going to staff those committees. But the next big fight is going to be the House rules package. Again, the plumbing that normally is completely ignored from headlines is becoming another big fight from Republicans. You had Representative Gonzalez saying he's a no on it because he's worried about potential defense cuts. Then you have another representative also speaking on Face the Nation, Nancy Mace of South Carolina, talking about the fact she doesn't like how it went down. And she doesn't know what the informal list is that Speaker now Kevin McCarthy was able to do in backroom doors. She doesn't like these gentlemen handshakes and what that can mean. So you're going to have the Democrats obviously united against this rules package, but at the same time, potentially some no's or absentees from Republicans. So potentially this is going to be another fight like it was for their speakership. And this is just the plumbing. My point is, when we get to really must-pass issues like the debt ceiling, there's going to be major fights.
Anne-Marie, we were talking earlier in the show about when it matters for markets, right? This question of we always get a debt ceiling debacle. We always get some sort of fight that goes to the last hour. How much are we going to see a different tenor this time around? When should the market start caring about ramifications? And what exactly would those ramifications look like?
I personally think the market should start caring now, or maybe they should have started caring last week. But this is going to really come to the forefront in early this summer. And then, of course, we have federal spending with the fiscal year ending September 30th. What the Republicans want is the fact that they want negotiations to be about raising the debt ceiling, concessions on federal spending. They want to cap 2024 spending at 2022 levels. Chip Roy has said over the weekend that everything is on the table. That would include defense. This is going to draw the ear of some of these hawkish defense Republicans. At the same time, Lisa, you have the administration saying that when it comes to the debt ceiling, there will be, quote, no hostage taking. That was the word from the president's press secretary at Air Force One to reporters yesterday. So I would say these fights are already going to start to happen now. Representative Chip Roy, ultra-right, he was part of this insurgency, is saying we need to get in a room now. I guess that is a good sign for the markets, but this is going to be a big debacle.
Very quickly, Anne-Marie, when McCarthy does a John Boehner and turns to the Democrats, what happens?
I'm not sure you're going to see that, Tom. I am not sure you're going to see this individual, even though, yes, it is a very slim majority, really want to turn to the Democrats. He's going to have to in terms of getting concessions, but it's going to be very difficult for him to want to get Democrats on board to pass legislation over the line. Because remember, to get this speakership, there is now a provision of one member can vote to vacate. That means one individual, and we've seen a few of these backbenchers call for a vote of confidence on his speakership. So he is coming into this position incredibly weak.
Potential chaos through the rest of this year, at least, that's for sure. AMH on tour in Mexico City. Anne-Marie, thank you. On tour. Beautiful place. You been there much? Mexico City?
Years and years ago. It's not the same now as it was.
Great restaurant scene, Tom.
Yeah.
If you want some recommendations in the future for next time.
Thank you.
At any time. I want to talk about Lulu, just briefly, before we get into Tom's routine in Mexico City.
Lululemon or Lulu in Brazil?
Lululemon right now, down by almost 13% if you're just tuning in. Lisa's going to give you some more detail on this in about 5 or 10 minutes' time. But Lisa, the margin story for this company, this stock at least, getting hammered.
And that's after they actually reported better than expected earnings. So this is the issue, is that they actually saw demand going up. This isn't a demand question. This is a margin question. This is a cost question, which really raises the issue. When do we start seeing the ramifications of that in the labor market? That's kind of what the Fed's been looking for.
Isn't this the story going into earnings season?
People are expecting Lululemon to be the norm. That's why you're seeing sort of Nike and Under Armour falling in sympathy. We'll get into all of that. How much, though, is this either sector-specific, industry-specific, where that isn't perhaps a suit going back to the office specific? I don't know.
There's a broader story here, Tom. Mike Wilson and Morgan Stanley.
Be careful now when you talk a broader story.
Mike Wilson and Morgan Stanley thinks we're really underestimating the amount of earnings damage that's going to take place here. going through the rest of this year.
I defer to the brilliant people we have on that work at this really hard, including Gina Martin Adams. I'm going to go right up the income statement and say some of the gross margin erosion that you see here in Lululemon is just very simply the revenue dynamic.
That's the equity market. We'll throw in the bond market as well. Next up, Mike Schumacher, Global Head of Macro Strategy at Wells Fargo on this program. Looking forward to that after a big move lower in bond yields in Friday's session. We try to bounce here up 3 basis points. Your 10-year, 358.93. Equity futures positive, 0.4%.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Massive week ahead. Chairman Powell tomorrow, CPI on Thursday, JP Morgan earnings on Friday. Going into it all to kick off things this Monday morning, we look like this on the equity market. Up by 15, 16 points on the S&P. Futures up 0.4%. On the Nasdaq up 0.5%. Adding to the gains on Friday. Big moves higher by more than 2% for the session, erasing a weekly loss and snapping the weekly losing streak we've seen on the equity market. Biggest weekly gain, Tom, going back to late November on the S&P after Friday's gains.
And the jumble of it all, John, and you know, SPX speaks volumes here versus an odd Dow and NASDAQ 100 with its tech bias as well. So I got to rely on the VIX, and the answer is the VIX has been remarkably static in a 21, 22 region. But that's what I'm watching. You talk bull market, I need to see a 20. I see it in 19 VIX. We're not there yet.
We'll pause for that bull market. I'll get to that in just a moment. This move on Friday, helped out by this move in the bond market. We had a 20 basis point move on Friday, 20 basis point plus in some parts of the curve. 426.40 on a 2-year right now, yields up by about a basis point off the back of not just softer wage growth, but also a softer ISM as well. Now, if you can throw in lower rates, throw in a weaker dollar, and throw in a China reopening story, this is what you get in EM. Stir it all up. It's not a toxic brew. What's the opposite of a toxic brew, Bramo? What do you want to call it?
Soft landing.
Is that what we're seeing in EM?
Yes.
Emerging market stocks from the lows of October are up more than 20%, TK. There is your bull market.
It's a breakout, and it's on a relative basis, John. You show the MXEF, the MSCI Emerging Markets Index, for those on radio. And what's important here, leg up, stasis, and now a new leg up. It's all news-based.
But is any of this because of a rip-roaring recovery in the economy, or really just hopes of a soft landing, giving some fuel to
Maybe it's just a run from gloom and a run from stasis.
Look, you heard from Alessia the longest 30 minutes ago. If you can get this China reopening story, if they can fuel that with wider budget deficits, which is what we're discussing this morning, you can get lower rates, you can get a weaker dollar. This is where people want to be. Whether you want to stay there, that's up to you. But this is the argument people are making.
And Alessio De Longus is saying perhaps this is more tactical than it is long-term
Sure.
bet on the developing markets. What people are worried about is some sort of deterioration in profit margins, and that's what we're seeing this morning, or at least the hints of it, out of Lululemon. We've been talking about the yoga pants for a while now, but for certainly throughout the morning, there's a question here about where some of the margin compression came from. I just want to give you this. The revenue is up between 25 and 27% on a year earlier and ahead of the previous target range. So the actual revenue is above expectations, but the margin, the gross margin, is expected to contract for the fourth quarter by about 1 percentage points versus the prior forecast of a widening, an expansion, even though it's small, an expansion of those profit margins. How much is this an example of what we're going to be seeing more broadly as workers cost more, as the materials cost more, as the rents cost more, everything? Where are these going to go other than in the profit margins? And you're seeing Nike and Under Armour, John, both falling in sympathy.
So basically what you're saying is it's not a top-line story, it's a bottom-line risk?
Correct. This is an issue, exactly what the Fed was hoping for, was basically something's got to give, because at some point, some of these companies cannot pass along the price increases to consumers in order to remain competitive. So they get revenue that's above estimate. They're continuing to sell, but those costs are bleeding into what they can take home.
You mentioned the Fed. The next stop for this Fed, Chairman Powell tomorrow, then on to CPI on Thursday. Investors looking for more signs price pressures are fading. Mike Schumacher of Wells Fargo weighing in, saying, quote, in our view, the implied terminal rate will respond about as strongly to a hefty print on core CPI as to a weak one. For the 2 prior months, we figured that a weak print would prompt a bigger market reaction. Tom, just Mike Schumacher there on the balance of risks around how this market will respond to whatever we get on Thursday.
Well, this guy that writes holistic notes pulling in the economics into the fixed income space as well. And his recent note, John, I mean, is just extraordinary in its nuance, not only in the United States, but also the transatlantic dynamics as well.
People lining up to buy fixed income into
yes,
23.
That's the heart of the matter. That's the heart of the matter.
It's the matter.
He joins us now. Michael Schumacher's global head of macro strategy at Wells Fargo with exceptionally acute notes. Mike, your acute note says higher yields. Are we all going to die if we have higher yields?
I hope not, at least not quickly anyway, Tom. And it's interesting when you think about the move on Friday. I agree it was huge, but still, the bond market has been so choppy, so volatile now for really the past 6 months. I wouldn't take too much out of one day's move. A lot of events coming up, a lot of progress in inflation, sure, but it's not yet time to signal, hey, it's all clear for bonds.
If we sum it all up into the Bloomberg Total Return Index, known over the years at Lehman Brothers and such, the answer is down ginormous with a little bit of a bounce. If you call for higher yields, does the blended Total Return Index seek new lows in price?
Yeah, it depends where you look on the curve, Tom. So if you focus on the front end, you probably still get positive returns. Let's say the 2-year Treasury, you've got such a high yield baked in that if yields were to go up 25 or 50 basis points, yes, it matters, but it's not going to knock out that 4+ coupon. In the 10-year area, very different story. A little bit of an uptick, long duration, you're looking at negative returns.
How much are you going to expect the market to move to a higher expectation of a terminal Fed funds rate in a very violent manner as they start to realize that the Fed is serious about what they're saying?
It's going to take a while, I think, Lisa. And the problem is the Fed's credibility, frankly, is not very good. If you look back a year, so go back to December of 21, take a look at the terminal dot or take a look at the Fed funds dot for 22. At that point, it was less than 1%. That didn't work out at all. So I think the market listens to Chair Powell, says, yeah, he sounds pretty serious. He's been talking tough for 4 or 5 months. But let's see how this pans out. Let's see if the Fed hikes in February. Let's see if the Fed hikes in March. The market's going to give the Fed not much credit, frankly, because the forecasts have been so poor.
Mike, I got to ask you, because we've been talking about this and kind of questioning how much we have to care about this, not to shift zones outside of Jay Powell, but we've been talking about the debt ceiling debate. And at what point this bond market will care about the potential for a default a la 2011. What's your expectation? Is it on your radar?
We're more concerned than we would normally be this far out, simply because of all the pandemonium in Washington over the last week. But the market's seen this movie a bunch of times. So typically people in the market don't care about the debt ceiling until 3, maybe 4 weeks before the extraordinary measures appear to be exhausted. And then they care a lot. So they care none a bunch. Then you see market shift, equities do strange things, T-bill yields spike, that kind of stuff. But we're not there yet. I think it takes a while.
Mike, I look at the total return index, and I know that guys like you are dealing in spread and relative yield analysis. Deborah Cunningham was on last week from Federated, and she stopped this show with her caution on it's going to be a clip a coupon year, and prices are going to go down. If we breach last year's carnage in the total return index, we go back to a price of 2016. Is that feasible, that we could see a second year of price trauma in bonds?
Last year was incredible, Tom. So thinking about the moves in the market relative to where the year began, blowing away forwards, I think that's very tough to imagine. Not impossible, because things have been so strange. But think about, let's say, monetary policy for the ECB or the Fed. What's the upper bound we'd put on maybe Fed activity this year? 6%, something like that. So that's much less movement this year than we had last year. For the ECB, maybe it goes 100, 150. Big moves, yes, but again, not really shocking the market as we had a year ago. So I think the idea, or at least hopefully the chance of repeating something like last year in the bond market's pretty small.
So you think that this year bonds will offer an offset to the potential risk in higher risk assets in the case of some sort of downturn?
I think it's a really interesting point, Lisa. And you think about these correlations between bonds and equities for, let's say, most of the last 10 years, you'd have this case where equities would sell off, bonds would rally, so bonds would provide that ballast. Last year and more recently, it's been, oh, yields are down, this is good for stocks. And we had this on Friday, too. So we don't have that correlation normalizing quite yet. I think it will, but it's probably going to take another quarter or two, is my guess.
Hey, Mike, great to catch up, as always. Interesting calls out there at the moment. Mike Schumacher there of Wells Fargo. To Mike's point, and I think Mike Dada mentioned it a little bit earlier, the equity market responds to lower rates, and then the equity market starts to respond to why rates are low. And the second part of the story comes a little bit later. So do you want to buy risk going into sub-50 contractionary readings on manufacturing and services? Yeah, maybe initially because rates have come in, but after that, you've got to trade bad earnings.
Although, how much of the badness is already expected, right? I mean, we hear about the whisper numbers, and I know Tom loves the whisper numbers, but how much is that really going to set the bar pretty low and then have companies jump over that hurdle, particularly in areas like tech? I mean, these are the real questions, or even the banking industry on Friday.
So we're throwing the Fed call as well. For those of you thinking that maybe this is done, Andrew Hollenhorst of Citi is saying, no way. He says this: we continue to think Fed concern about loosening financial conditions amidst tightening labor markets imply unappreciated hawkish risk, including a 50 basis point hike on February 1st. He goes on to say, Tom, and this published just seconds ago, this is even more the case after the dramatic decline in Treasury yields just last Friday.
Well, yeah, the move in yields, I think, is part of that parlor game. What I like about what Hollenhorst has done is he was early on this call, and he stayed with the call and the nuance of the terminal rate, and I guess we'll hear about that from Powell. There's a Q&A there, isn't there?
There is.
Yeah, and so, you know, you got to believe we're going to reframe the Q&A. What I take such issue with, John, is the parlor game of gaming rate cuts. I've never seen this, where we're going up, And I get it, we're gaming up, measuring going up, a la Anna Wong and Andrew Hollenhorst. But then I'm supposed to game as well when we come down.
Yeah, apparently you're meant to price the recovery to the recession we haven't had yet. Tom, if that makes sense.
Yeah, the total return index. I take huge issue with the financial media where they quote yield, 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 and relative yield. Lisa, you're a pro at this. I'm not. But I'm looking at the total return index. If it goes down 6.2%, we breach into new lower price on bonds.
It was a bear market in bonds, unlike anything we've seen in modern history. The issue that I have is people are talking about the Fed, and then we got this better than expected data, deceleration in inflation in Europe, and people cheered. And the ECB came out with a report today saying wage inflation is actually going to probably prompt even more rate hikes. So they're becoming even more hawkish.
What's their number on wage inflation?
Of some of their, well, they're just saying that it's going to be bigger than expected. Price gains have exceeded their 2% goal for a while, and they're concerned about where that momentum is coming. Core inflation came in above the prior month. This, again, is really notable and really shrugged off by the market.
In New York today, John, and I go to the history of London, of the United Kingdom and France, with their labor unrest, we have two separate groups of nurses striking in the greater 5 boroughs of New York this morning.
Saw the same thing.
This morning. Mount Sinai and another hospital. I'm sorry, I don't have that name here. That's real.
It's been a feature of the last year, hasn't it? The return of labor leverage, labor power.
I would say so, but I how do you run a hospital without nurses?
With great difficulty, Tom.
Yeah, quick, we'll bring management down.
Jane Foley of Rubber Bank's going to join us very shortly, the head of FX strategy. Some big moves here. Euro dollar approaching 107, 106.89, at 0.4%, and China taking down that final barrier to entry. No quarantines now, Tom.
Final barrier
but then you've got to find the money to get the flight.
Come on, they'll print the money. We'll talk to Ms. Foley about that. That's
looking forward to that. Can you print the money?
Yeah.
I think that's what I was suggesting,
Yeah,
Tom.
$35,000. That's what I was expecting.
Has TK got a printer?
The Keen pills.
35K for business class. Is that business or first? What is that?
It's business. I don't know.
I thought you checked the prices.
It's business. It's, it's outrageous.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Brazil's President Luiz Inácio Lula da Silva is vowing to prosecute rioters who stormed the country's top government institutions on Sunday. The insurrection by thousands of supporters of ex-President Jair Bolsonaro follows months of protests since the conservative leader lost to Lula by a razor-thin margin in an election runoff. Lula is calling for federal intervention. On Capitol Hill, new House Speaker Kevin McCarthy is rallying Republicans with promises to cut spending and strengthen border security. Still, in order to win the position, McCarthy had to give more leverage to the party's right wing. He promised a rule change that would allow a single lawmaker to call for a vote to oust the speaker. President Biden has declared a state of emergency in California because of flooding and mudslides caused by heavy rains. And that clears the way for federal assistance. The state is bracing for another storm beginning today. 5 to 7 inches of rain are expected, with some mountain areas getting up to 10 inches. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
By the time the Fed is done, they're going to have to raise rates at least to 5.5 by the middle of the year, maybe even higher. I think nobody's talking about higher. What if inflation doesn't decline? What if service or wage inflation stays high? We have to get used to an inverted curve all this year, in our view.
That's the call from Priya Misra of TD. She thinks that rates can go well through 5% and have a little look at 5.50 over at the Federal Reserve, that the yield curve stays inverted all year and we get a recession in the back half. Is that depressing enough for you or what? Your equity market right now on the S&P 500 looks a little something like this. We advance 0.5% into Chairman Powell tomorrow, CPI on Thursday, JP Morgan earnings on a Friday. Yields, Tom, are a little bit higher by 3 basis points, 358.74. Equities up, yields are higher. Euro just a little bit stronger against the weaker dollar here. Euro dollar 106.92. And look out, crude 76.40, up 3.6%. You've got China reopening, talk of wider budget deficits out of China, at least the consideration of doing that. You wonder where crude could go, Tom, through the year ahead.
It's going to be interesting to see. And, of course, a lot of the angle here is up to $100 a barrel, just as a convenient number. Everybody got that wrong last year. It's about the timing. And John, I'm going to go as the key factor. There's got to be China opening.
Oh, without a doubt.
Yeah.
Tom, without a doubt. And you've said this a million times, I think we all have around this table. This is year 3 of pandemic economics.
Yes.
If you want to make a fool out of someone, ask them for their year-end oil forecast, because oil has a habit of making people look very, very silly. And at some point, Tom, we're going to work out that we've got something very, very wrong on this China reopening story.
We are going to shift. I hope Powell addresses this today in his Q&A. We are going to shift from an odds supply side dynamics of economics over to a traditional demand side analysis. We're not there yet.
I hope it's that simple. Because on the supply side, when it comes to China, I really don't know if this leads to supply chain relief or further supply side dislocations later off the back of a boom in demand.
And this is what people have been talking about. When do they start requesting more natural gas imports? When do they start pressuring the prices? CICC research came out and said that actually their chances of starting to import a lot more LNG, liquefied natural gas, is going down because they're turning to cheaper types of things like coal.
Out of Australia.
Pipeline gas, domestic production. And so they might not even begin to do that, which will not pressure on that front.
And we'll have to see. Right now, we are going to go to the deepest part of what we do in equities, bonds, currencies, commodities. Always, it is the foreign exchange market. And we do it with Rabobank, with their immense heritage of being on the other side of speculation, making commercial transactions go. Jane Foley holds court at Rabobank. Jane, wonderful to have you here, and timely as well. Buried in your note at the bottom is dollar bulls do not give up. Why should the dollar bulls not give up as we see weaker dollar moving into a trend?
Well, you know, I think if there ever was a year of a two-handed economist, I think this is going to be the year. There are so many different permutations and combinations. I think hitting the market, so many different ways you can argue the issues that are at hand. And I think particularly positioning now, I think we've got to look at the events that are before us through the prism of positioning. And what we've had in the last few months of the year into this year is the market really selling off on its long dollar position. So we're going into these fundamentals with the market no longer long dollars, and the market very, very long euro, and that's got to colour some of the news that we've had, particularly I think around the Fed.
You do this differently because of the heritage of your bank. You people do a lot of hedging, a lot of business transactions. Is there a dollar bet on the other side of speculation?
Well, there is, yes. I think the answer to that is yes. But I think if we look at the reasons that the market has been selling off the dollar in the last couple of months, and it's surrounding, the attitude towards peak US and of course, or peak Fed. Now the Fed remains pretty hawkish. I think we can argue this both ways. Will the Fed cut interest rates this year? Will it not? There's lots of different views out there, but this argument is going to look different when the market's no longer long the dollars. And similarly, we look at what's been ramping up the euro long positions over the last couple of months. This is all related to the gas price, to less pessimism about the European economic outlook. But again, the news flow is going to hit differently when the market's already long euros. So I think what we're in for is an awful lot of choppy trading as the market reacts to the ebb and flow of this very volatile news flow. From now, this position of being not long dollars and very long euros.
What's the range then you're looking for?
I think the range is going to be large, and I think this is a new world here. And I would go as far as to say is that the low volatility that we had, in recent years was the outlier. I think that was a function of very cheap money in the wake of the quantitative easing years. And with that rein back, I think all investors are much more exposed to economic fundamentals. They have to look at economic fundamentals and be more worried about it because money's more expensive. And I think that's going to make a much more choppy environment, probably not just this year, last year, but actually in years to come, until perhaps we get cheaper money again for whatever reason. So I think we could be seeing euro dollar in 1.2 to maybe 1.8, 1.9, 1.10. I think we've got a lot of choppiness to come over the course of this year.
Jane, you raise a lot of really good points. This question of which data this market responds to. We saw softer than expected inflation prints in Europe, with inflation coming in more than expected, that on the headline number, but that had to do a lot with the energy prices. Not with respect to core inflation. The market didn't respond to that. We see the ECB coming out and saying consistently they are going to hike rates more and that they see potential momentum in inflation. What is the market responding to with the optimism aside from just the strength because of the better than expected outcome with the winter and energy?
Well, sometimes the market responds to what it wants to respond to. It sees what it wants to see. And actually right now it's ignoring some of the hawkishness from both the ECB and from the Fed. And I think in terms of the European data that we had last week, yes, those headline numbers were coming lower. Yes, they're going to come lower because of lower energy prices and because of base effects as well into the year. But those core numbers were higher. There is the effect of tight labour markets. This does make it an unusual downturn because labour markets across almost the whole of the OECD are so tight, and this does mean that services sector inflation could remain more sticky, and this is what central banks are worried about. This is why they retain this hawkish rhetoric, and they're warning perhaps the market, don't get too hyped up on the fact that we're going to be cutting interest rates in the foreseeable future. They may not be. We have to wait and see.
What's your high beta trade EM right now? I got to make some money before our Arsenal Spurs here this weekend. Jane, what's your high beta EM pair right now?
Well, we've seen, the dollar sell-off. We've seen people go shorter on the Mexican peso. I think that's probably going to carry on. But, if you talk about this, I always like to put the Aussie in here because the Aussie traditionally is seen as sort of the high-risk trade within the G10. And actually, that's no longer. Australia is running a current account surplus. It's an energy exporter. The interest rate differentials are much narrower than they used to be. And I think that means that Australia is no longer going to be seen as this sort of high-risk currency, and I think that one could perform quite well this year.
Interesting. Jane, thank you. As always, brilliant. Jane Foley there of Rabobank. Tony Dwyer of Canaccord, just publishing moments ago. Give us the recipe. Give us the recipe, the ingredients for a significant rally. Here are 3 of those ingredients for that recipe. 1, the Fed stops tightening and adopts a clear course of accommodation. 2, earnings and/or valuations reach depressed levels that reflect recession and has been broadly priced into risk assets. And 3, a historically extreme level of oversold pessimistic tactical conditions. Tom, he says, at this juncture, we have none of the above.
So none of the above market for Dwyer. What's important here is he is a congenital bull, and he's really pushing against that right now.
Futures, Lisa, up 0.4%.
Again, how long can it last, especially in light of what we saw from Lululemon, right? At what point does the tightening that we've seen start to bleed into some of the earnings and the earnings compression that we're expecting to see,
I don't agree with individual companies moving this thing around. Lululemon is you know, they're doing what they're doing and they're struggling. Isn't Nike, when we saw them like 3 weeks ago, doing better?
They're not struggling. This is the interesting fact. They're actually increasing revenues at 27% year over year. They're actually doing wonderfully. The problem is the margins. The actual profit is coming in because of the expenses that they're not passing along to consumers. This is the issue. Can you get a better economy and worse earnings from companies? This is sort of the inverse of what we've seen over the past decade.
When Bramo says, hold on a second, TK, you know you're in trouble.
No, it's not in trouble.
That's when the hands start going. You know, that's why you're between us. Horton's hands are worse. Horton looks like she's landing a plane at National. But, you know.
At Mexico City. You know, beautiful. Okay, coming up, Vishy Tirupatur, the Global Director of Fixed Income Research at Morgan Stanley. Vishy's going to join us shortly with a little look at the bond market after a massive rally on Friday off the back of some weak data. You know, equity futures, Tom, up about 17 points on the S&P.
Inelastic is my waist. The license to train jogger is $128. I'll pay $10 more.
Is that how much it is?
Yeah.
Did you buy some? Are you wearing them now?
No.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars
the time the Fed is done, you're going to have to raise rates at least to 5.5 by the middle of the year, maybe even higher.
I don't think 5.1 or 5.4 is really that big a deal. I think it's more just how long that we stay around those levels.
The Fed is going to end with a 5 handle. Now, whether that's closer to 5 or closer to 6 is going to depend on the strength of the labor market.
We are not yet seeing a significant tightening in labor markets from the significant tightening in interest rates.
We have a tight labor market, but let's recall that recessions begin when labor markets have reached their peak.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. A most interesting Monday on the way to Thursday with an important inflation data, China reopening as well. And John, what I know when you sum it all together, the Bloomberg Financial Conditions Index for Chairman Powell's going the wrong way. We are almost back to the accommodation seen just before Jackson Hole.
And for that reason, not my opinion, but the opinion of Andrews Hollenhorst over at Citi, is that means the Fed's got more work to do. It's going to be very interesting to see how he responds to the data we had just on Friday, not just the labour market report and the resilience we saw in the labour market through most of last week, but also those sub-50 contractionary surveys for manufacturing and services in America.
Vishy Tirupati of Morgan Stanley coming up in a moment. Michael Schumacher at Wells Fargo partitions from short duration 2-year acting radically different than longer duration paper.
So he thinks yields can go up, right? That's basically the call over at Wells. We've got QT at the Fed, QT at the ECB. Lisa this morning mentioned the European Central Bank signaling more rate hikes to come. And the ECB, I think what's original about what the ECB is suggesting is they're acknowledging that we could have, may well have, probably are in a recession in Europe right now, yet they still want to hike interest rates. That tells you a little something about this moment for these central banks and what it could mean for risk.
Let's go. I was making fun earlier, Lisa, of how, financial media and all look at the spread market and the dynamics between high yield, investment grade, and full faith and credit. But what are those dynamics this morning? We really haven't touched on them.
You've seen an easing in financial conditions there as well, and that really has been the theme throughout risk assets. You've
high yield
spreads
does better.
Spreads coming in pretty directly for high yield. Just to give you a sense of how much. The high that you saw in October was 1 percentage point above where it is right now. Just to give you a sense, that's how much we have moved down. 1 percentage point, a full percentage point in just the spreads. How much is this going to give the Fed ammunition to keep hiking rates? And this, to me, is really the interesting question. Because the market has eased, because the market is more excited about the growth prospects and not the risk of Fed rate hikes, does that push the Fed to do more?
To both of you, is Powell going to move the market today, John? I mean, there's Q&A you mentioned. Is it tomorrow? Excuse me.
It is tomorrow, yeah. Will he move? I've got no idea. I think, look, it's always about emphasis when you hear from a Fed speaker. And there's two things that he said in the last news conference. He is the chairman, so his words matter more, of course. In the last news conference, he said 2 things. One, we're not sufficiently restrictive yet. And the second thing he said is we're getting closer. Now, what does he choose to emphasize here? The getting closer part or the fact we're not there yet? Because this is what this market kind of trades on. It's where the emphasis is. And we heard from Jim Bullard just last week, right? And he basically said we're getting closer. And everyone said, well, he's dovish. We're getting closer to sufficiently restrictive. Do they know where sufficiently restrictive actually is? The ECB is saying the same thing. I mean, for a lot of people, we might have been there 100 basis points ago. We might not be there yet in the minds of others.
I think Lori Calvasina actually said the dirty secret out loud in her note, where she basically said she's surprised at some of the questions that have nothing to do with inflation, that have nothing to do with the Fed. People are looking for anything other than that to talk about because they're sick of it. And economists came out over the weekend and said, we have no idea. We've been terrible with inflation. So perhaps people are throwing up their hands and trading on what they want to do and seeing what they want to see.
Just to get out front of this, and the importance of Thursday, on the 18th, I don't believe we've mentioned, is retail sales, the state of the American consumer, which folds into that GDP guess as well. I mean, those are the 2 signposts along the way.
Well, let's add to Friday. This is what the equity bulls want, right? They want unemployment at 3.5%. They want growth resilient, and they want inflation pressures to soften. Now, the question we've got to ask after Friday, is it sustainable to expect wage growth to decelerate and unemployment not to climb? And that was what was unique about that report that we saw on Friday. Unemployment dropped to 3.5 and wage growth softened. Can that continue? A lot of people are hoping it can. That screams soft landing if it can. But it's way too early to make that call with any confidence.
What happens to margins, though, in that kind of picture? Can you get a perfect soft landing and still see stocks do poorly because margins end up compressing?
Sure, there's a massive difference. At least you've said it a million times, a huge difference between what the market does and what the economy does, Tom. And we've seen that several ways over the last few years.
I'm going to focus on the data. I'm going to go to data dependency, which I'm sure is what Vishy's going to tell us in a moment. Speaking of data, John, let's do it. We had oil up $81 a barrel, Brent crude a 3% move in oil. But I guess the story this morning is the resiliency we see in equities.
And euro dollar, hello, 107. A little bit earlier, that's the high of the session. 106.92 right now, up 4 or 0.5%. Equity futures up a third of 1%. Just a monster rally on Friday, up by more than 2% on the session. On the week, up by about 1.5. Biggest weekly gain on the S&P going back to late November. And you can say thank you, not to the payrolls report, say thank you to the ISM reading. That survey was just dreadful. ISM Services Index dropped 7 points. So that's the biggest drop we've seen since the start of the pandemic. The reading was 49.6, the lowest since 2020. Business activity, orders, dropped the most since 2020. And yields fell off a cliff off the back of that, Tom. So it wasn't just about payrolls. I would say it was hardly about payrolls at all. It was all off the back of that ISM at 10 Eastern on Friday morning.
I'll go with that. Right now, we're going to get a further guidance here from the depth of the fixed income market. Vishy Tirupati joins us, Global Director of Fixed Income Research at Morgan Stanley. Vishy, when you and Mike Wilson sit down, he's on the equity side, you're on the bond side. You guys have the mother of all fractious debates. That's the heritage. Where are you and Mike Wilson most on the same page right now?
I think John just hit the nail on the head. I think the most important data point on Friday, this is what Mike and I talked about, is that was not really so much the payroll data. Payroll data was informative. The most interesting thing being the average hourly earnings coming up below expectations. But the most important data was the ISM data. The ISM data, both new order indices for services and manufacturing significantly below 50. This suggests a broad-based contraction in demand for goods and services. And this is very much the point that both Mike and I see the economy slowing significantly. In terms of the Fed outlook here is whether our economists have Fed going to 450, 475 target price range and stopping there. And I think the most important thing, whether they do that or another 25 basis point more, it is really not that important to me. What is important to me is how long they stay there, how long they stay in a very restrictive manner to and that's what is consequential. And this is again a point that Mike and I agree is that what Fed is indicating is that they are willing to put up with a lot of pain, and some of the data from the payroll data gives them additional impetus to stay elevated and much longer, and at the risk of significant slowing in the economy, and that's the outlook we are looking at.
So, Vishy, with that in mind, we hear from Chairman Powell tomorrow. How do you expect him to acknowledge, at least respond to the survey data we've seen so far?
I expect that he would acknowledge that the inflation is heading south. That's there is plenty of information to show that. Also see that if there's some slowing of the economy, there's significant indications to that front as well. So this is what I expect him to say, that we want to accomplish slowing of the economy and bringing the pace of inflation down, and this is going along the lines that they have been calling for.
Do you think that the rally has gotten overdone in the long end so far this year?
I think we made a big call. Our interest rate strategy team made a call of going long the 5-year point. So we think it's time to go long the 5-year point in the curve. I think the trade works whether we have a soft landing as people hope for, or a hard landing. In both those under both those circumstances, I think being long the 5-year Treasury works. I think the overall point being that if we have a significant economic slowdown and the shows up in earnings recession, it's bad for Mike Wilson's view of the world. It's bad for equity earnings, and that lines up with his view of the world. And at the same time, the probability that the Fed would be looking to cut at some point would start to getting priced into the market, and that bodes well for the fixed income markets. So all of that comes back to this year being the year of fixed income.
With that said, a lot of people are piling into this consensus trade of long investment grade bonds. Some people saying that it's going to perform better than both equities and any kind of currency pair that you could get. Are you piling on that train?
I wouldn't say we piled on. I think the rest of the world is piling onto our trade. We've been early to call for. We've been early to call for high quality credit as the trade to be in. We continue to stick by that trade.
Vishy, I love you. It's great to catch up. Vishy Tirupatu of Morgan Stanley.
Love that.
I mean, he's right. I mean, you told me months ago the same thing, but it's always funny when they say, no. My trade, we were first. Mike Wilson of Morgan Stanley probably feels the same coming into 23. My trade, I was first. It's going to be a bad year ahead. This is what Mike's got to say if you're just tuning in. More downside ahead. He said to us a number of weeks ago he thinks the downside could be as much as 20% plus. In fact, I think it was just last week we caught up with him when he said that. This morning, he wrote the following with the team at Morgan Stanley just to start the week. With both the sell and buy side consensus so aligned, what he's talking about here is this massive dip expected in 23 and then this recovery trade in the back half. Everyone is starting to wonder how this view could be wrong. He goes on to say, we think it's in the magnitude of the move lower, led by much weaker earnings and a Fed committed to fighting inflation. And for that reason, I'm not sure if anything's ever an easy sell or an easy buy, but he thinks 3,900, Lisa, is an easy sale.
And this, to me, is the most interesting part of his call. It's not the direction, it's the scope, the potential for the downturn that is most interesting.
ZK?
I'm going to say that the market is fragmented into the zombies, the less profitables, which is the margin erosion you're talking about, and a select group that probably will go through all of this without, breaking a sweat. But the heart of the matter is the inflation call. And that's why Thursday's so important.
Massive.
You get a disinflationary trend down to whatever level you want to talk. That's the elephant in the room for, that's the key part of the equation.
You know who's taking Thursday off? Lisa.
Why would I not?
Just retiring.
It's my days.
It's very early to take vacation.
She said, "Can I use your days, Tom?" And
Seriously.
I said, "Yeah, I have no life, so why not?"
She just screamed at me, "I'm going skiing. I don't care what you guys said. It's okay. Go skiing."
Evidently, there are tickets that are cheaper than $35,000 to travel one way.
Good for you, Lisa.
Thanks, you.
If anyone deserves it, you do.
Thanks.
Yields up 3 or 4 basis points on a 10-year, 359.30. Your equity market higher by 1/3 of 1%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The capital of Brazil is recovering from an insurrection by thousands of supporters of former President Jair Bolsonaro. Now, rioters ransacked Congress, the presidential palace, and the top court in Brasilia on Sunday. It took hours for security forces to regain control. New President Luiz Inácio Lula da Silva is vowing to prosecute those rioters. President Biden is in Mexico, where he'll meet with the leaders of Mexico and Canada. Now, that summit is aimed at easing tensions over migration and drug smuggling. President Biden faces continuing political pressure over a surge of unauthorized migrants from Latin America. The European Central Bank is strengthening the case for more interest rate hikes. It predicts that wage growth, a key indicator of where inflation is headed, will be very strong in the coming months. The ECB says that reflects robust labor markets that haven't been substantially affected by the slowing of the economy. In New York City, more than 7,000 nurses at 2 major hospitals went on strike today. The nurses at Mount Sinai and Montefiore say that staffing levels at private sector facilities are inadequate and that pay should be higher. The pandemic led to the high turnover, and that forced hospitals to fill gaps with expensive travel nurses and push their margins negative. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think that the Fed is imposing a severe slowing on the economy, and then the recovery from that will be stronger. So there will be cyclical leadership again, but we still haven't felt all of this in the economy yet. We will probably see that recovery within 2023, but not soon.
That is the dip in the first half, the rip in the second half, and a consensus view there from Steve Whiting, the chief investment strategist and chief economist at Citi Global Wealth Management. I'm sure he won't appreciate being consensus, but ultimately for 2023, it's kind of consensus. Equity futures right now on the S&P up by a third of 1%. Futures rallying here off the back of gains on Friday. We build on that. Yields trying to bounce back from an aggressive move lower in Friday's session following payrolls and the negative survey reading on services in America. That ISM sub 50, a big drop from the previous month. Yields up by 3 basis points, 387.74. And as China dismantles COVID zero, crude up by more than 3% here, Tom. 76.25. Brent with an 81 handle.
Nice pop. As Lisa mentioned, we're done saying Happy New Year. It's over. And part of it at Bloomberg is a heritage of our international coverage. It's been with us. We mentioned the 30th anniversary of Bloomberg Radio and TV here last week. And what that means is we parachute in worldwide almost to 100 of our executive editors and key staff who make Bloomberg Surveillance go. Their people are what inform us each and every day. This morning's chosen victim is Will Kennedy. He's senior executive editor for energy and commodities.
Congratulations.
Wanted to start his day at the crack of 10 a.m. and he came in at 8:17. It's a little later London time. I don't feel sorry for you as well. China reopening means new demand. Do we know demand elasticity, responsiveness, and hydrocarbons, or are you guys guessing as you go?
We don't know in China. I think it's the important question this year. Clearly, in the big cities, the worst of the first wave is over, and people are trying to think what that looks like. We got some interesting news out of China today. Private refiners get quotas from the state about how much oil they can import. They just got a very big one. So those quotas are running 20% ahead of where they were.
They're bringing in 20% more than what you thought.
They're saying the refiners can import 20% more if they want, which I think is a signal that the government expects a big jump in demand. How big? We don't know. But clearly we know from reopenings a year or two ago in other parts of the world that once this happens, people really want to fly again, and they want to drive again, and they want to see relatives again. And you've got the Chinese New Year coming up, and I think people will really be watching how busy those airports and roads are. And after 3 years of lockdown, there's going to be, you would think, a lot of pent-up demand.
Perhaps, but where that demand gets filled is the question, right? Because is it going to come from natural gas, from crude, from some of the supplies that the rest of the world have been trying to tap into, or is this going to come from coal, from gas, and from oil in Australia, as some people are suggesting, cheaper sources of energy?
When you talk about China and energy, I think the answer over the years has always been all of it. They need lots of energy, and I think that means, to different degrees, more of all that energy. I do think, though, when it comes to crude, that's what, when it comes to people flying again, driving again, that has to be crude oil. The gas question is very important for the global market. Clearly, their gas imports have been depressed over the last few years, and that's one of the reasons why the energy crunch has not been as bad as some people feared in Europe. If they start importing LNG again on a serious scale, that could quickly end some of the softer gas prices that we've seen in other parts of the world. But I don't think that's clear. And of course, the end of winter is in sight in all of the Northern Hemisphere, including China.
I'm pretty surprised as I start reading through the situation in Europe and the situation, the questions around China. In Europe, they're getting more imports of natural gas than they want at this point. Yeah. They're getting more deliveries. How long can this dynamic last? Is it more driven by demand side or by supply side coming and meeting some of the demand?
Europe's caught a lucky break with the weather. I think it's really, that's the biggest part of it. It's been an exceptionally warm start to the year, and it was a pretty mild first half of the winter last year. And that's really suppressed demand, combined with energy-saving measures, combined with a lot of factories shutting down and cutting production. Europe is in a much better place than it expected to be, and that gas has already been ordered. Those stockpiles are much more full than people expected. 91% full in Germany, much higher stockpiles than you would typically see in a winter. And that's right. That means the cargoes are coming in now are, not really needed, and that is depressing prices. The summer will matter. I don't think people should be complacent. They're going to have to refill stockpiles without any Russian gas at all, more or less, this year. That's going to be hard to do. And a cold snap at the end of this winter, a cold start to next winter, it could change.
Has any of this changed the investment decisions of the Exxons, the Shells, the BPs, the Chevrons of this world?
At the margin, perhaps. I mean, we saw a pretty big number out of BP for how much they're going to invest in the US next year. Some of that was due to an acquisition. And of course, we've got very high inflation in the industry, which skews the figures. But I don't think we've seen any wholesale investment. It will be very interesting to see what gas projects get invested in, both in the US this year, what contracts get signed for gas export in the US this year, which will allow people to develop more LNG export terminals, or whether we get any new projects in places like Africa. We might see it in gas. I think oil is a lot less, investment seems to remain very suppressed.
Do you get the sense that the Europeans have changed their mind on anything over the last 12 months, given the experience of the last year?
I think that European politicians would be happy to see gas investments in the US, in Africa, in a way that they probably weren't thinking about a year ago. They're not going to shout about it from the rooftops, but when I was in COP27 in Egypt, there was a lot of controversy about the German chancellor sort of, on the one hand, saying you've got to be net zero, on the other hand, talking to African governments about whether they'd like to sell him any gas. So I do think there has been a subtle shift, John. I don't think people will be shouting it from the rooftops. So.
Are you going to be able to get back in time to see Tottenham Arsenal? Are you
the question, Tom, is do I want to?
I mean, that's really what matters.
Tom's basically asking, can he come with you?
Yeah, John and I are trying to get there as fast as we can.
No, I will. I'll be back early on Saturday, just in time to see Tottenham win against the odds, I think, Tom.
Okay.
Have you checked ticket prices?
Well, yeah, I call them up, and they've been extremely
I looked at some of the Arsenal tickets in a couple of weeks' time, and completely sold out. Completely, so you can't get them. And my friends who are members there just saying that to get tickets for Arsenal this year, given how well they're doing in the league, it's just almost impossible.
I was thunderstruck on my last visit there, the number of Arsenal fans I ran into. I mean, they're huge.
We just don't have that developed secondary market in the UK for the
and
Premier
all that.
League.
Yeah,
they
it
keep
really
it.
Works.
They try and keep it in-house amongst the membership in a way that I think, in the US, if there's a big game and you've got the money, there's a price. Whereas in the UK, it's a little bit more difficult.
Well, since we got here, what's Javier Blas thinking about? I mean, he's such a star for us, writing for Bloomberg Opinion. When you talk to Javier, what's he fulminating about?
I think that he would admit that the energy crunch hasn't been quite as severe as some people predicted because of the weather, but I think he would tell you that it's not over yet, that next winter looks
Which is what
bad.
we're hearing.
Yeah. I think Javier has been phenomenal, just highlighting the hypocrisy of politicians, and we'll mention that some of these politicians won't be shouting about it from the rooftops, but maybe let's not follow the rhetoric and just follow the decisions. The decisions have certainly changed, Will, in a big way.
I mean, I think the other thing that's worth watching this year is metals. We've seen a big pop in metals, and that's the other market that may really benefit from a Chinese reopening and a Chinese investment, and stocks are very, very low. So that's, you're talking a lot today about softening inflation, and commodity prices have softened. But I do think there are areas where commodity prices could come back sharply.
So copper, do you look at LME or do you look at Chicago copper? Which price do you use?
I think most people still look at the LME price.
Oh, thank you.
I mean, there's no home bias there, but of course, on the same page. Will, this is special. With us all week.
This was so good. Can you come back tomorrow? We'll slot you right. We'll talk to our people. We'll talk to your people.
Thank you, Tom.
Will Kennedy, thank you. Out of London, just a phenomenal commodities team.
This is the
I mean, we say
history,
that so many times, but truly it is.
In the intro, I mentioned the executive editors, and this goes back to a guy named Stuart Wallace and Justin Kerrigan, and we made a commitment, and Mr. Winkler made a commitment years ago that we were going to own this up against John really good competitors. Commodities are Americans don't know this. It's a world business. And, you know, the fallout of 10 and 15 years of investment is to have a team that, you know, I mean, Javier is visible, but there's a whole bunch of other people grinding away at this.
For much of last year, it was the story.
Yeah.
The story. Crude right now, Brent, up to about $81 a barrel, up by more than 3% on Brent.
Chicago.
WTI up by 3.2%, 3.3% higher to $76 and about 20 cents.
I met Will at the Dorchester, the miners' convention.
Yeah, LME week.
Yeah, he looked at me and says, Tom, you don't want to put an umbrella in your drink.
We'll be the first to tell you that LME week has changed a lot over the last 5 to 10 years. It's not what it once was. Coming up, Christian Mamani of Lafayette College in the next hour. Looking forward to speaking to him and Marilyn Watson of BlackRock and Dan Suzuki of Richard Bernstein Advisors as we count you down to the opening bell in America.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Bloomberg Surveillance, we say good morning to you, Lisa Bramwitz and Tom Keene here. An eventful Monday morning, and of course, there's Srinatarajan to join us here in a bit on an important day for Goldman Sachs. We welcome all of you of Global Wall Street this morning. He'll be joining us here in about 10, 12 minutes as we look at a set of anticipated layoffs at Goldman Sachs, I should say, and we'll follow up on that as we can. Right now, we've got futures up 20, Dow futures up 121. The VIX somewhat stable here, 21-22 level. Don't want to make much of it. There is an equity lift, but it's accompanied with a pullback here. Higher yields this morning off the huge lower yield movement that we saw on Friday. 2-10 spread, 67 basis points. And in the foreign exchange market, dollar gives it up a little bit here. I should point out yuan off the China news, 6.78 on Chinese yuan. Right now, on the economy, on what we saw on Friday in the adjustment forward, she is with ADP, automatic data processing, is without question most locked into our paychecks of any company in the country. She's their chief economist. Neela Richardson adds value. Neela, good morning to you. Neela, I really want to focus in here on what ADP sees, not your proprietary stuff. I don't need to state secrets, but with the advantage of your payroll knowledge, what did you learn Friday, and how does it amend your view forward?
Well, we learned that our firms, our clients, over 1 million clients, are still hiring rather aggressively. We also learned that hiring intensity is coming from small and medium firms that were blocked out through a lot of the hiring in 2022, outmanned by larger firms when it came to benefits and wages. And then the third thing we learned, and I think this is really important when you talk about the next steps for the Fed, is that wages are moderating. They are. But they're not moderating quickly enough to make even a 2% inflation target seem reasonable at this point. They're still quite high, almost double what they were going into the pandemic. Right. So there's still a lot of work to do when it comes to wages and getting them down to a tolerable pace of growth that meets the Fed target. The
economist John Farrow has really emphasized the ISM numbers on Friday as well. They show some sogginess. How does Neela Richardson define a soft landing? I have trouble with that phrase, but if we don't like the phrase soft landing, where are we going with that optimistic outcome?
Well, to me, a soft landing is a landing you can walk away from. And I think the economy is strong enough right now, at least it looks like that it'll do so. We pretty much got a Goldilocks report on the 6th. And I'm going to say more about that in a second. But we got a report where you still saw strong jobs growth and moderating wage growth. That's like the perfect scenario for a soft landing. The question is, will that trend continue? And I think what people get wrong about the current state of the labor market is that all of this is cyclical, that it can be controlled by a slightly higher interest rate. Much of what we're seeing in the labor market right now is structural. And if you look at the hard data, you'll see that employment growth over the next decade is expected to be half of what it was the previous decade. That means labor shortages are persistent, and the specter of higher wages, especially in the service sector, will be with us for some time to come.
So in other words, Neela, if I were going to sort of put a bow on that, are you basically saying that hope of a soft landing based on the print that we got on Friday is perhaps more wish than reality?
I'm saying that the door's still open, actually, but that door swings both ways. We still have a robust labor market, 3.5% unemployment rate. I mean, there's no getting around that. That's a strong labor market. And you're seeing initial jobless claims barely above 200,000. That's a really strong labor market. However, that's a labor market that's also at risk of higher wage pressure at every turn. So this idea that the Fed can just get to this terminal rate and then pivot, to me, that door is closed. I expect to see federal funds rates higher for longer, for some time to come, because the labor shortages aspect of the labor market isn't going away.
Well, people will point to the services ISM, which you mentioned, that was weaker than expected, that came in with contractionary territory, and then areas like the housing market that have seen incredible destruction in terms of how much prices have come down, perhaps not that significant, but certainly the volume of sales. How much more is there to go in some of the industries that have been first hit by some of the tightening Fed funds rate?
Well, let me point out that the issue with housing is more structural than it is cyclical. It's not just higher mortgage rates. People have bought housing at much higher mortgage rates than what we're seeing now. It's about the monthly payment. What we're seeing in housing is just the lack of inventory, and that hits at a supply issue that has been an issue for over a decade. And that supply issue is likely to get worse with higher interest rates. So that's something that is structural. But to get back to your question, we can't expect the labor market to behave in a uniform way. This is a very fragmented market. And so you're seeing interest rate sensitive sectors like manufacturing start to slow. We've seen that firms that overhired last year, like information technology, they're starting to pause and slow. But at the same time, when one door closes, another door opens. You see that in the JOLTS data. There's still a lot of job openings, and there are firms waiting in line to scoop up that headcount right now in this very tight labor market.
Well, that's where I wanted to go. I mean, I don't know if you've got any interior knowledge on this, Neela, but let's go there with all the bias you have in excellence with ADP. There's this tech hemorrhage going on right now. Do those people find jobs?
It's too soon to tell how quickly they find jobs. And I think that underlies your question, how quickly they find jobs. We don't expect them to be part of the long-term unemployed of 6 months or more that you see in other segments of the population. But it's how quickly they are absorbed. And my feeling is that those skills are readily absorbed, not necessarily in tech, but in other sectors of the economy that benefit from advanced tech and data skills and software development. Some of these technologies that were really important during the pandemic have now gone mainstream, and companies are more likely to need tech talent in the future than less. So I expect that these numbers will be quickly absorbed, though it's highly disruptive for people in the short term.
This is really, really important. And Lisa, would you agree with me? This is in the zeitgeist that there's a lot of carnage going on in technology, but I'm sorry, there's an American job economy out there. Maybe on a stock basis or the hopes of a tech stock boom, you don't make the same compensation, but it's not like they're going out into a nothingness.
Which is the reason why we haven't necessarily seen it in some of those numbers, Neela. This really raises a question. At what point do we start to see the destruction in the numbers that we're seeing in certain industries? Are we ever going to see it? Could we see a recession without necessarily an unemployment rate that picks up all that much?
If we do, Lisa, it'll be the weirdest recession in U.S. history. I mean, I start from first principles, the jobless claims numbers. Those numbers are super low. And then I add the unemployment rate, the 50-year low. And then I see the robust hiring. And yes, there could be some softness next year, and we could see weaker hiring next year. But the fact that firms are still hiring, when all expectation is that the economy is slowing significantly from last year and definitely from 2021, that makes the hiring even more remarkable. It tells me that what we're seeing is impervious to interest rate hikes, that there's something more going on, and that companies still need to hire and find qualified talent.
So Neela, just to sort of wrap this all up, you said that you think that this ultimately will push the Fed to raise rates to a higher level for longer and keep it there for longer than people currently are expecting. Can you give us some parameters of what you're expecting and when it will be felt by an economy that still has been resilient?
Yeah, I don't know if the Fed's path is through the labor market. I know the narrative is that if we can cripple the labor market, we can slow down hiring, we can spike up the unemployment rate, and that we can crush wage pressures, that's going to lead to lower inflation. I'm not sure that's the path anymore. I think what we need actually is to see more people enter the labor market. And unfortunately, what that means for the Fed is that it's not just a monetary response, it's a fiscal response. It's a jobs retraining response. It's a get people into those interviews response, which needs more federal and local support, not just monetary support. So the idea that the Fed can do this alone and fix the labor market, bring down inflation, and get people back into the labor market is, I think, a little idealistic. So the Fed can only stay in its lane. I would expect to see a federal funds rate over 5%, and I would expect them to hold there for quite a bit of time. That means through 2023.
Neela, thank you so much. A brief from Neela Richardson of ADP this morning. I want to turn to Global Wall Street right now. Srinath Rajan to join us here. Lisa, as we mentioned with Sonali Basak earlier, the anticipation of, I guess, normal January change at Goldman Sachs.
Culling of this herd, basically, as they return to something more normal after not laying people off during the pandemic, both because it didn't look good to lay people off, but also because they were going gangbusters in the face of easing monetary policy.
And another story at Canaccord Genuity, we mentioned Tony Dwyer, their strategist who's with us a lot. Canaccord Genuity is Western Canada. I know them from their acquisition of Adam Harkness and Hill, I believe it was, out of Boston years ago. Maybe that's where Dwyer came from. I can't remember. All right, it's ancient history. I mean, this goes back 40 years with Tony. But Canaccord Genuity is so upset with their stock price, they want to take it in private. And it goes to the zombie roll-up, not to say that Canaccord Genuity is a zombie, but their senior manager just thinks the stock price is unacceptable. So there's a lot of and Jeffries this afternoon, I should point out.
Although we haven't necessarily seen the huge amount of corporate buybacks that many people were expecting, which has been a big question mark. When are we going to actually end up seeing that? And so, again, how much is this push-pull going to take place? Can I just say one thing about what Neela Richardson was saying there?
Please.
Because we've been asking about the potential for a debt ceiling debate, what the turmoil in Washington, what the effects would be. And there Neela was saying that ultimately the potential for growth and actually decelerating inflation comes from that fiscal response, from retraining employees, from perhaps more targeted immigration policies that probably won't get done if we take, and this is where I'm extrapolating out, if you're looking at some of the gridlock in D.C.
I'm going to look at the data. I go back to this, and I'm sorry. Oh, Jane Foley. Jane Foley, I thought, was brilliant on the volatility we're all living day to day. And for me, all you can then do is fall back on the data, and the ECO screen becomes the most important tool that I have going forward.
The problem is it's a choose-your-own-adventure eco screen. It's a choose-your-own-adventure number of data points that you can basically frame in whichever way you want because there's something for everyone. So that's where it gets complicated. When does it become a trend? We won't know until it might be too late, which is the same story as for the Fed.
For Global Wall Street, stay with us. Srinath Rajan, I believe, to join us next. Futures up a buoyant 22. We're buoyed, or?
We're buoyed. We can say buoyed.
We're buoyed. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Brazil's President Luiz Inácio Lula da Silva is vowing to prosecute rioters who stormed the country's top government institutions on Sunday. The insurrection by thousands of supporters of ex-President Jair Bolsonaro follows months of protests since a conservative leader lost to Lula by a razor-thin margin in an election runoff. Lula is calling for federal intervention. President Biden has declared a state of emergency in California because of flooding and mudslides caused by heavy rains. That clears a way for federal financial assistance. The state is bracing for another storm beginning today. 5 to 7 inches of rain are expected, with some mountain areas getting up to 10 inches. Richard Branson's Virgin Orbit says it's on track for Britain's first ever space launch tonight. Now, the takeoff of a modified Boeing 747 jetliner with a rocket under its wing is planned between 9:40 and 11 p.m. The mission will deploy 9 satellites for a range of customers. And Deere has reached a deal with the American Farm Bureau Federation to allow farmers and their ranchers to repair their own equipment. The agreement gives farmers access to diagnostic and repair codes, as well as manuals and product guides. Now, it also allows them to buy tools directly from Deere and get help from the company when placing orders. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
This is a market that is split between kind of soft landing and hard landing scenarios, but where the consensus expectation around declining inflation, leads the ability for the Fed to pivot.
Jeffrey Rosenberg, portfolio manager at BlackRock, there with a chat on the jobs report and then on to the ISM number, which was grim, not grim, but difficult, I'll say, on Friday. And that gives us the up equity market that we saw Friday, and it continues today. Futures up 20, Dow futures up 118 as well. We're going to do three things here. We're going to get to Srinath Rajan here on Goldman Sachs and on a January for Wall Street. But Lisa, there's a headline of a war that just won't go away. Moments ago, the United Kingdom considering sending battle tanks to Ukraine. They joined Germany in analysis, France, and of course the United States.
Trench warfare, some people describe it as that, basically the akin to it in 2023. And the effort to try to support Ukrainian troops. There was a story in the New York Times over the weekend that I thought was interesting about how others who have a gripe to against Russia are joining the fight in Ukraine, that there are troops coming in from other areas. Yeah, exactly, to try to support the fight. So we shall see as we enter into a colder period.
Battle tanks needed, perhaps at Goldman Sachs as well. Srinath Rajan joins us here on the uniqueness of this moment for Goldman Sachs. Cut to the chase. Is this about dumb decisions in doing SPACs, et cetera, et cetera? Is it about the bank, the Marcus, and all the rest of it? What's the backstory leading to 3,000 plus layoffs today?
That certainly will be a touch harsh, Tom. Yes, what Goldman Sachs is doing is going deeper than rivals. It is shedding jobs and what any of the other banks have planned as of now. But it is really hard to pin it down just on mistakes. The consumer banking foray has not gone great, and they have outlined a retreat there. However, you also have to look at the fact that through the pandemic, they didn't do the usual cut of underperformers as usual.
Right, Lisa
and they've had a big jump in headcount. Under David Solomon, you've seen headcount increase 34% since the end of 2018 to almost 50,000 employees now. So while they are planning 3,200 cuts, that works out to about 6.5%. But just in terms of sheer numbers, it is one of the biggest exercises Goldman has ever carried out in terms of job cuts.
I'm showing my vintage, but does the leader have the partnership's support?
Partnership might complain and grumble about a variety of things, but you're emerging from a very difficult 2022 where the Goldman Sachs stock, even though it was down about 10%, it was still a better performer than almost all the other banks. It just pipped Morgan Stanley towards the end of the year and definitely way bigger than the bigger consumer banks heading into 2023. So if you have a lot of complaints at this moment, it feels a little misdirected if it is all targeted at David Solomon.
A lot of people have seen the job cuts as a positive. It's certainly if they're an equity investor, they see this as perhaps trimming some of the expenses in a positive way. Will it be received that way after next Tuesday? Will the earnings bear out that this is really a good exercise to prepare for perhaps a leaner future?
The earnings will definitely show you why they needed to do something like this. They have set return on equity targets. They're not going to meet that for the year 2022. They're barely going to tread water on the 10% mark. Their target is somewhere in the 14 to 16% mark. And of course, they will say we do not judge that on a year-on-year basis, but shareholders and investors don't necessarily look at the long term, even though they would like to think that's what they do. They look in the now, and when the numbers don't match, they want to see management taking some action. And that is why you see them going ahead and saying, we are tackling the uncertain environment we're heading into. We're tackling the ballooning expenses with this measure.
We already know that deal making has been slow. We've seen investment banking slow in terms of profits. We talked about the SPACs, no longer the easy money. I hate that phrase, but here we are, not necessarily there. But how much is this also because of, for example, loans that have remained on the books that had to do with mergers and acquisitions that were made during a better time and now having to accept losses? How much is due to just turmoil in the market gone awry in specific portfolios?
There are certainly industry-wide trends that Goldman is not immune to. You have had a big decline in investment banking fees. Let's not forget asset management. You've had a big decline in asset prices. And a year ago, that was a massive boost for Goldman Sachs. That helped them increase their revenue that year by 8 to 9 billion just because of price gains in asset prices. That gain is not going to be there this year. So when you lose such a big chunk and you have this little consumer banking experiment, the new division that they're going to unveil, which will have losses, or at least pre-tax losses that will show as more than 2 billion. It might be a bit of an accounting kirk, but it is still more than 2 billion. It's still a problem.
Tom, did you like how he did that? He called Marcus that little consumer banking experiment.
He's so smooth. I mean,
I love Sri.
Just like lights out. What do the 3,200 to 3,800, whatever the count is, people do? They're going to go out, they're going to have parchment, a resume that says they worked at Goldman. Is it like they get a job right away? I mean, is there pixie dust involved here? Or is this going to be an HR slog for these people?
Look, that's the hard part here. We're all talking about how investors will react, how shareholders will react. Yeah. But this is also, at the end of the day, a very human process. You have going to have 3,200 people who are going to go out into a very difficult 2023, into a very difficult job market. Even though they say there is a war for talent, it is hard to imagine other banks. They might not be cutting as many jobs as Goldman Sachs, but they are still not going to be out there hiring aggressively. I will point out one thing, though, and this is important. As bad as the number is, and as hard as it is to say there is a little bit of good news here, there is a little bit of good news here, because just a few weeks back, management ranks were talking about cuts that could be approaching nearly 4,000. This is about 20% less than that. So if that's where the number is finalized, that's a small bit of good news.
On the tech side, we hear big tech companies laying off a significant portion of workers. We used to hear that there was a war for tech talent in the banking industry. How much are you seeing the banking vortex bring in some of the tech staff that's being laid off?
We certainly saw a lot of that over the last few years, but let's look at the cuts that are taking place this week at Goldman Sachs. All the conversations we've had with our sources across the firm indicate that a number of those hits will be affecting people who are working on the tech side, on the engineering side, because that's where you'd seen a lot of headcount growth.
Interesting.
You can't just build a digital bank for the future without ramping up aggressively there. You can't roll out a lot of these new products without staffing up on that front. And that's a place which is ripe for cuts, unfortunately.
One question before we let you go. Is everybody back in their seats in the office? Is it being in person really important?
Well, over the last 2 years, one theme has been very clear. If there is one bank that has been adamant about one...
Come on, you talk to everybody.
One would hope not. We'll find out at the end of the week. But surely, I cannot expect that being a factor in cutting jobs. But to Lisa's
No, but are there tech guys at Goldman Sachs having a tantrum because they got to darken the door 5 days a week? Cut to the chase.
They might have been throwing tantrums, and we certainly heard a lot of complaints out of 200 West over the last couple of years. But right now, they don't have a vent for those complaints. Right now, they want to keep their heads down and hope that they still have a job going into next week.
I mean, you're only working here. You're working 4 days a week at home, right?
I count 5 days a week in the office, Tom.
Really?
Of course he does.
Bassick doesn't do that. You know.
Yes, she does. Everyone works very hard here. Look, I don't think that necessarily being in the office also indicates how hard people work, but there is a shift back to a culture of being more in person, particularly for the banking
I need the surveillance
industry.
cork on this. I got to be careful. Anyway, Sri Natarajan with us here. We do this into January, into earnings of banks. He will be most busy on the movements on global Wall Street here through the coming days as well. It is a different January in New York City. I would say that. Between two strikes by nurses and the turmoil on Wall Street, it's just a different, we're post the pandemic, I get it, but wow, is it a different January?
I feel like this is the first year that we have a sense of what the post-pandemic reality might look like.
Strongly agree. Right now.
Yep. And that last year was still recovering from the pandemic. This year is different. This year is, okay, reset. People get back to the offices however many days a week that they are agreeing to do so and face something that's going to be a very mixed picture economically.
That's good. Well, economically, but also politically. I would suggest that, with all the school trauma and that, maybe we get to some normality that we have not had, and that would be right now. But we'll pay attention to this, and our local people, of course, with those nurse strikes. That's a big deal for New York City.
Yeah, especially because we are heading into the trifecta of various illnesses. It's not over, despite the fact that people are ignoring it. I do want to mention Lululemon shares.
A toxic brew of illnesses.
Well, I mean, it is. I mean, it's a disaster, and people don't seem to care anymore. It's just sort of like, yeah, you're sick, you're something. I honestly, look at that. There is this coming. Morgan Stanley's John Pruzan, a one-time CEO candidate, exit the firm.
That is a big deal through the morning for global Wall Street. He is the chief financial officer of Morgan Stanley. There are 3, if not 4 people under Mr. Gorman, and everybody, including Mr. Gorman, is a young Turk. This is really, really interesting to see.
A 28-year advisor to James Gorman exiting the firm.
John Pruzan to lead Morgan Stanley. Stay with Bloomberg. Good morning.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Live from New York City this morning. Good morning, good morning. Trying to build on the gains of Friday. Equity futures up 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York City, we begin with the big issue. What a week. Goldman Sachs set to cut 3,200 jobs ahead of earnings. Chair Powell set to react to softer wage growth with the latest CPI read just around the corner.
We're watching the data, payrolls, the CPI data.
Chair Powell is just going to reinforce this idea that they're slowing down now.
Now we're debating, are they going to go 25s?
The difficult balance for Powell in the months ahead is going to be to try to continue on this path of moderation.
They're very concerned of being the Fed that paused too early.
Friday's jobs market report.
This has the signs of being a soft landing report.
They really want to get to a level that squeezes the life out of lagging indicators of inflation.
That's exactly what they're after.
You have to take this Fed at its word that if they don't see improvement and persistent improvement, that can go a bit further.
It comes down to the economic data.
You can't write off another 50.
You have a setup for the Fed to over-tighten monetary policy.
Joining us now to discuss is BlackRock's Marilyn Watson, Krish Mamani of Lafayette College. To the both of you, thanks for being with us. And before we look forward, let's look back just a little bit to Friday. Marilyn, can you tell me what's more important, that labour market report that came out at 8:30 or the ISM that came out 90 minutes later?
Well, I think they're both important, and they're both suggesting very different things about the economy. So the labour market report overall was generally pretty positive, although obviously the markets also took well to the fact that average hourly earnings were down or weakening, but overall I think the labour market data still showed a pretty robust economy. On the other hand, obviously the ISM was pretty negative in terms of the overall path of the economy and economic activity. I think really the key, though, is going to be this week in terms of the inflation data, in terms of CPI. I think the Fed, along with other central banks, is still very much focused on inflation. I think February is going to be a live meeting, February the 1st, and I think really that the CPI data is something that, above anything else, the Fed is really going to be concentrating on this week.
Marilyn, when you say live, what does that mean? That they could go 25 or 50 or not at all?
Yeah, so I think the debate is probably between 50 and 25. I think the bar would be incredibly high for the Fed to not move at all. I think they've continued to really indicate that they're going to continue to hike rates until they feel that they're at this restrictive level, that they've got inflation on a path, on a trajectory that's definitely going to come down to a sustainable lower level. So I think it really is between probably 25 and 50, unless we have a really, really outsized event in terms of the CPI data this week.
Krishna, Chairman Powell speaks tomorrow morning. On the one hand, I've got to ask the question, which one is it? On the one hand, right now, the survey data says things are bad. On the other hand, you look at the labour market report and headline payrolls say things are pretty decent. Krishna, which one is it?
Well, the Fed has been pretty clear about this for quite some time. That is, what they are focused on singularly is really the labor market data. And if the rest of the economy slows and labor market remains tight, they have already told us that they are going to continue to tighten. So I think I don't expect Chair Powell to say anything new anytime soon. And he may actually take the opportunity to reinforce the point that he has been making over the last few quarters.
The odd quirk of the labour market report on Friday, Krishna, was that wages softened and unemployment fell to 3.5%. And I guess I've got to ask you, Krishna, how sustainable you think that is. Can wages continue to decelerate without unemployment rising?
Well, I think they can. And I think if you look at the kind of the under the hood, there are some really good data points to point out that may actually come about without significant rise in unemployment rate. But temporary workers, hours worked, all of those are simply pointing out that while people are not letting their workers go, they're cutting down the amount of output that they're getting out of those workers. So I think employment data or employment number perhaps is the lagging indicator in this labor report.
Marilyn, do you agree with that assessment?
Yes, I think it is a lagging indicator. I also think that there are some very structural issues still in the labour market as a result of COVID. So when you look at the trajectory that you would have had in terms of people employed in areas such as healthcare and other services, there's a massive deficit there compared to the number of people employed in those sectors now. So I do think that you have some support in areas that have been negatively impacted by COVID. And I do think that also overall it is a lagging indicator as well. So I think you can see the unemployment rate maybe rise a little bit, but I think it's going to remain relatively supported for some time.
25 minutes away from the opening bell, equity futures right now, positive 0.5%. The path through the rest of this week pretty clear. We have Chairman Powell tomorrow morning. You have CPI on Thursday, then JP Morgan earnings coming up on Friday. Mike McKee, Chairman Powell tomorrow morning. What are you looking for?
Not a whole lot. It is not an event where he would be talking about the economy. It's on central bank independence, and it's a panel discussion with a bunch of other central bankers. But here's the story going into it. When you look at what happened on Friday, you brought this up at the top of the show, and you asked the question of what does it mean? We saw jobs, and we saw the ISM report hitting the 2-year note yield. Which one is more important? Are jobs telling us inflation's going to go away faster, or is ISM telling us we're going to have recession? That's the question all over Wall Street. And as you mentioned, Jay Powell speaking tomorrow probably is not going to give us a real answer at this point. However, Thursday we get CPI. That'll be the sort of the marker for Wall Street on what we get at 25 or 50 on February 1st. Friday, Michigan inflation expectations. I'll call that a half of a number, half of a data point, because that has mattered to the markets in the past. But other than that, not much going on this week. Now, the real debate is about whether the Fed is going to go too far or not, and that'll play into the decision for February 1st. Remember this quote from the minutes last month? An unwarranted easing in financial conditions would complicate the committee's effort to restore price stability. Well, you take a look at this. We are seeing an easing in financial conditions, and we saw that most definitely with the 2-year note yield. This is the Bloomberg issue. When you get up to zero, you get up to the red line there, that starts to get into completely easy conditions. That's not what the Fed wants to see. So expect, if he has a chance, Jay Powell to sound a bit hawkish, but expect other Fed officials talking this week and next to sound hawkish as well.
And Mike, thank you. Just a monster rally into the front end of the bond market on Friday. The 2-year yield dropping by more than 20 basis points off the back of that softer than expected ISM. This is what Citi's got to say about it. Andrew Hollenhorst says this: we continue to think Fed concern about loosening financial conditions amidst tightening labor markets imply unappreciated hawkish risk, including a 50 basis point hike at the start of February. This is even more the case after the dramatic decline in Treasury yields last Friday. Krishna, do you agree with that?
Yes, wholeheartedly. I think if you think about it, if the Fed wanted to reinforce its message to the market, this was really a perfect opportunity for them to do that. Whether it is 25 basis points or 50 basis points from impact on the economy, it really doesn't matter that much. But from a signaling standpoint, it'll matter a great deal. Basically, what they would tell the market is they are on the case, they will remain on the case, and we are not there yet, and don't expect us to get there anytime soon.
We've got to ask ourselves, not just what Chairman Powell's going to say, Marilyn, but how much weight those words carry. Do you think they've lost a little bit of weight over the last few months?
I don't know that they've necessarily lost any weight. I think that they've been very consistent. Chair Powell has been consistent in reinforcing that they really want to get to a point where they're above probably the neutral rate, where they're maybe in restricted territory, and where they do feel that inflation is on a sustainable lower path. And so I don't think they have lost the weight. I think that they're really signaling that they're willing to do as much as it takes. And that now isn't yet the time to start suggesting that they're going to pause or even start cutting. And I think maybe the market is a bit premature in actually predicting that the Fed might even start to cut this year. I think that's not necessarily our base case.
This equity market on Friday, 38.95 at a close on the S&P 500. Mike Wilson of Morgan Stanley says 3,900, easy sell. This is what he had to say to start the week, with both sell and buy side consensus so aligned. That look for a dip in the first half and a rip in the second half. Everyone is starting to wonder how this view could be wrong. We think it's in the magnitude of the move lower, led by much weaker earnings and a Fed committed to fighting inflation. Mike Wilson says 3,900 is an easy sale. Christian Mamani, I have to say, reading through your notes, you think the real pain trade here is an equity market that could get back to 4,500. Can you weigh those two risks for me?
Sure. So I think Mike, to some extent, may be right. That is, we are still very much in the trading range with respect to what the Fed is articulating as to their path forward. Having said that, given where positioning is, and if we get favorable data coming through over the next few quarters, the market is certainly not positioned for a 4,500 by mid-year. And I think that's why it will be the ultimate pain trade for the market at the moment.
That's the equity side of the story. Let's talk about the bond market side of the story. Marilyn, lining up to buy fixed income in 2023, almost every single investor I've spoken to. Marilyn, what's the risk that yields actually go against that view?
Well, so I think we're certainly in a far better position than we have been, at the beginning of last year. And I think given the massive repricing that we saw last year, fixed income, I think, is a relatively attractive asset class now. Particularly, I think, when you talk about risks, we like the carry and the income that you can get, particularly in sort of the risk-free area of the bond curve. So if you look at the front end in treasuries, when you look at little or no duration in terms of high-quality investment grade, and other asset classes, maybe in the MBS market as well, then I think actually there are a lot of attractive opportunities. And the key there, I think, is to really understand the liquidity, is to understand the risk-reward dynamics, it's to understand the impact of the duration, and to really focus on those aspects where you can really get some very, very decent carry and some decent returns. But you are looking at relatively low risk, even if you do see a change in the interest rate dynamics. And I think that's the key, to really make sure that you're not overly interest rate sensitive in your portfolio.
Marilyn Watson, Christian Mamani, sticking with us. Looking forward to the conversation coming up in just a moment. Mike Gapen of Bank of America, publishing just moments ago, we do not see the Powell Fed as facing a new conundrum. The Fed should worry less about markets pricing cuts in 2023. If the Fed commits itself too strongly to no cuts in 23, then it risks leaving policy too tight for too long. That was Mike Gapen of BofA, literally about 60 seconds ago. We'll pick up on that a little bit later. Coming up on this program, DC finally delivers a speaker in the House.
I am now ready to take the oath of office. I want to ask the Dean of the House.
Now will the Speaker designate raise his right hand.
But that took a while. Plus, President Biden touching down in Mexico City. We'll catch up with AMH over in Mexico in just a moment.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
oath of office.
Speaker designate raise his right hand. Do you solemnly swear that you will support and defend the Constitution of the United States against all enemies, foreign and domestic?
Yes, I do.
Congratulations and Godspeed.
Well, that took a while. Speaker McCarthy winning the gavel after a historic four-day battle. The House returning to business amid a potential hurdle over the rules package. This coming as President Biden travels to Mexico City to meet his Mexican and Canadian counterparts. Our team coverage begins right now with AMH in Mexico City and Emily Wilkins in Washington. Anne-Marie, first to you. Walk us through the president's agenda through the next couple of days.
Well, Jonathan, this afternoon he's going to be joining along with First Lady Jill Biden, really just a welcoming ceremony by AMLO. And then him and AMLO will have the Mexican president, Andrés Manuel López Obrador, more colloquially known as AMLO. They will have their own bilateral meeting. And really the focus of this meeting, Jonathan, is going to be migration. They just struck this deal last week that the president announced. Mexican officials are also on board with this deal. On top of that, another big one is going to be shared security. And the White House talks about the fact that they are going to talk about the fentanyl crisis. Mexico, Jonathan, you can imagine, is going to point to the fact that they just got a huge arrest with El Chapo's son, which the U.S. has put pressure on Mexican authorities because they consider him one of the major traffickers when it comes to fentanyl. This is a huge issue in the United States with John Kirby, Admiral Kirby of the National Security Council, talking about the fact on Friday that since August, they saw an increase, and what the Border Patrols have been able to take in is 20,000 pounds of fentanyl. On top of all that, when it comes to the drug trafficking, migration, then they will talk about trade. One of the big disputes Canada, Jonathan, and the United States have with Mexico some nationalist policies when it comes to energy.
Emily, 2 points there. The first one was the border. The second one was trade. The Republicans want to focus firmly on the first one, on the border. Emily, how united do you think Republicans can be in the year ahead?
Well, certainly Republicans are united on some measures. We're likely to see that later today with a vote on the rules package. There have been some Republicans who have raised concerns, but at this point, it is expected to pass. We're also going to see Republicans come together today. You remember that funding that Democrats passed that gives more money to the IRS? Well, Republicans will be voting today to withdraw that money. Now, of course, that's not likely to pass the Senate or get to Biden's desk, but it's going to start being things that show that Republicans are more united. I think the biggest questions looming over everyone right now, and Republicans have told me they're very aware of this, are things about the debt limit. They might not be happening for a number of months, but we've already heard lawmakers like Chip Roy come out and say we need to start working on it now so we don't go down to the final minute. And I've had lawmakers like Patrick McHenry tell me this is really one of the most important things that Republicans need to do. So I think some things on their agenda you're going to see a lot of unity on. The question is really those big bills that are going to sort of make or break the U.S. in the next year.
AMH, is this president ready for a debt ceiling fight later this year?
Well, we already heard from Karine Jean-Pierre, the president's press secretary, speaking to reporters on Air Force One during Biden's trip to El Paso yesterday, Jonathan, and she said that they will not allow this issue to be hostage-taking. What the Republicans want is something we have to see the Democrats potentially negotiate on, and something they do not want to do. Republicans basically are saying, if you want us to be able to lift the debt ceiling, then we need concessions from you when it comes to spending. And that is why this is going to be a huge fight, because the Democrats obviously have control of the Senate, but the Republicans just have a very slim majority in the House.
AMH in Mexico City will catch up with you over the next day or so. Emily Wilkins, good to have you back down in Washington, D.C. as well. Goldman Sachs put out a note at the end of 22, looking out to 23, on this very issue. And this is what they had to say. Raising the debt limit, probably not soon, probably not easy. Running down the roughly $500 billion cash balance could finance the deficit until August, but funds could run dry as soon as July and as late as October. Back with us for a final thought is Krishna Mamani and Marilyn Watson. Marilyn, I want to come to you. I hear a lot of people say I don't care. They want to know should they care, and they want to know when should they care when it concerns the debt ceiling.
So I think they should care, but whether it's in the immediate future, I think is less. I think to say the market is still very much focused on other issues such as inflation, the labour market, the other data that we've seen. But as the year does progress, then as in previous years, it could become another issue that the market really focuses on. As you know, the market really only focuses on one thing at a time. But I think it's certainly something that if it does look like it's going to become an issue, then it is something that the market will eventually focus on. I think this year, though, overall, is a very different year where the market has a lot of different things to focus on as well. When you look at China very, very rapidly reopening, when you look at the energy crisis in Europe seems to be rapidly abating as well. There are a lot of different dynamics that also I think the market wasn't necessarily focusing on last year, that this year I think add a different tone as well. So the debt ceiling is one of many issues, but I think for the time being it's not going to be the focus.
I think you nailed it. Your colleague Rick Reeder told me a long, long time ago, markets can only focus on the shark closest to the boat. And the shark closest to the boat right now is not the debt ceiling debate, but Krishna, we've got division between parties, within parties. And I think people are asking the question, do we face the risk of a 2011 repeat, Krishna?
Well, I mean, we certainly face a risk. Whether that is a measurable risk or not, I can't really tell you. From the standpoint that by August, September, the economic outlook could be very different than what we have today. And therefore, I think the gravity of a potential 2011 repeat would be far more acute in August than it seems today. And I think that will probably help get it through. Again, there's no certainty, it's politics and it's difficult to predict, but that's not something that I'm too worried about at the moment.
Krishna, with that in mind, is that a worse outlook for the economy but a better outlook for the market?
Yes, absolutely. I think the worst outlook for the economy for sure in terms of slowing from very high levels of both nominal and real growth rates. But the real question at that point would be how close are we to a potential recession? And if we go down this path of playing with the largest capital market in the world, how do we want to risk tipping that into a recession that was avoidable?
So let's finish on this. Marilyn, if we get into this situation where this risk is measurable, it's prominent, and it's something we have to grapple with, tell me how the market responds to it. Do you expect treasuries to respond how they always respond, which is with a bid, a rally, lower yields?
It's possible, but I think also the dynamic will really be very much, I think, Krishna was right when you think about the impact on the overall economy, and it depends what state the economy is in then. And at the moment, the huge amount of debate is whether it's going to be a soft landing, whether it's going to be a hard landing, or somewhere in between. And I think that really will make a very big difference in terms of the Fed's response and in terms of the Treasury response as well. So, if you look at historical, performance, then it is likely, but I think it really is very important to look at it in the overall context of the market and the overall economic performance.
Marilyn, Krishna, to the two of you, thank you. Marilyn Watson, Krishna Mamani, two of the best on fixed income and on the equity market as well. Your equity market right now, S&P 500 futures up 5 or 0.6% on the S&P, adding to the gains of Friday. Payroll's got all the credit. That move over in the bond market was all off the back of the ISM. In contraction, big move lower, dropped by about 7 points from the previous month. Was that just the weather, or is something worse going on here in the US economy? We moved about 20 basis points at the front end on Friday. We're down another 1 basis point on a 2-year today. Your 2-year yield, 4.23, call it 4.24 if you like. On a 10-year right now, 357.63. Yields higher there by just a couple of basis points. So a little bit of steepening coming back into a very, very inverted yield curve. Coming up, the morning calls, and later, RB Advisors Dan Suzuki seeing a change in stock leadership. More on that with Dan around the opening bell. Your opening bell, 7 minutes away.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one. This kid could actually be the president of the United States someday.
when it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Starting to work our way through the trading week. Chairman Powell tomorrow morning. On Thursday, we get CPI data in America. And on Friday, it's JP Morgan numbers. Going into that, equity futures up 0.6%, about 4 or 5 minutes away from the opening bell. On the Nasdaq, up by 0.7%. Into the bond market. Mention this move low we saw on Friday. 2-year yields dropped like a stone by 21 basis points. Off the back of an ISM Services survey in negative contraction territory. Not good news for this Federal Reserve if they're trying to avoid a hard landing. The good news was in the labour market report. Now, your outlook might depend on the data you're looking at, and at the moment, I think you can cherry-pick the data and explain whatever you want about your outlook and justify it, perhaps. Yields lower at the front end by a basis point. That's the price action in the bond market. Let's get you some morning calls. Piper Sandler upgrading Oracle to overweight, 104 price target, citing growth in cloud revenue and operating profits. Jefferies upgrading CureVac to buy, 21 price target, seeing potential in early trials of new COVID and flu vaccines. And finally, Bank of America double upgrading Zillow to a buy from underperform, expecting new initiatives to lead to higher revenues. Up next, looking for a change in leadership, Dan Suzuki of RB Advisors.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
Coming off the back of the biggest weekly gain on the S&P 500 since November. That was last week, the biggest weekly gain since November. Trying to build on that this morning. Good morning to you. About seconds away from the opening bell. Equity futures up by 0.6% on the S&P. On the Nasdaq 100 up 0.75%. On a Russell up by 0.8%. There's your opening bell. Switch on the board and get to the bond market. Monster move on Friday off the back of that ISM. Yields lower, much lower at the front end. Trying to bounce this morning on a 10-year yield up by a couple of basis points to 357.82. The ECB signals there's more hikes to come. Euro dollar reclaims 107. 107.17 on euro dollar. Positive there by 0.7%. And crude trying to rally here. We'll talk about China and reopening with Damien Sassower of Bloomberg Intelligence in about 15 minutes. Look out for that conversation. Crude up by 2.5% to $75 and around about 60 cents. Around about 25 seconds into the open here, equities up by 0.5% on the S&P. On the Nasdaq up by 0.9%. One name to watch at the open, Lululemon, plunging after the company cut its margin forecast on surging costs. Abby has more on this one. Hey, Abby.
Hey, John. Well, yes, Lululemon appears to be the first, maybe the only, but certainly the first of the retailers to admit that holiday 2022, well, it wasn't so good. And this is not a new story. If you recall, in early December, they reported a brutal quarter, all about margins not coming in where they were supposed to, profitability not as high as expected. And so this is weighing on other retailers. Well, not as much anymore. Under Armour and VF Corp coming off the lows. But relative to those gross margins, it's a pretty significant shift that they have made in a press statement initially this morning, and that is that gross margins, instead of being up 10 to 20 basis points in the fiscal fourth quarter, the quarter we're in now down 100 basis points, or 1%. So this now means 4 straight quarters of contracting gross margins. My thought, as similar to early December, get over to that Lululemon on December and see what great deals they have. But this, of course, translates into weakness for the stock, the worst day for the stock of the year. Now another down year, knowing that the year is young. But the reason this matters, well, actually, it's actually up just slightly on the year there. But last year, a down year, John, the first time since 2013. Will this company be able to get it together in time? We don't know, but perhaps not the best way to start the year after having been higher last week.
That's for sure. Abby, thank you. Stocks hammered, down by about 10% in early trading. Different story for Alibaba, the stock leading Chinese tech gains, with the PBOC announcing an end to its 2-year crackdown on the sector. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, Jonathan. Beyond sort of being caught up as part of the China reopening trade, there are 2 key catalysts with Alibaba's stock this morning. The first, a comment from a top central bank official in China, Guo Shusing, who basically says that the 2-year crackdown on China tech focused on those 14 internet companies and their financial business is basically or essentially coming to an end. At the heart of this story has been Jack Ma and him stepping back from Ant Group, the financial affiliate of Alibaba. The other key catalyst was on Saturday, the company appointing 10 individuals, giving them voting rights, which essentially strips Ma's control from the company. It's been a really interesting story. You look at Alibaba's stock over the course of 2022, very difficult year. And while that chart doesn't fully demonstrate it, from the trough in October to present, we've actually rebounded some 70%. A part of that is the reopening trade, this idea that growth estimates for China in 23 are improving. Then there's the specific equity story. You look at analysts' calls on this stock, the percentage of buy ratings improving in recent weeks. Goldman Sachs, for example, has added Alibaba to its conviction list, both on this kind of reopening and recovering conviction call, but also that improving regulatory environment. And then Alibaba is Morgan Stanley's new top pick for this year. They're also interested in other internet stocks in China like Meituan. I think there's kind of some growing optimism about the growth story in China for 23, particularly for tech, particularly for e-commerce. That said, we're still concerned about the spread of COVID-19.
Big time. That stock is up by 4%. Ed, thank you. As always, it's not just China tech. EM equities. EM equities are up more than 20% since the lows of October. As I say, we'll catch up with Damien Sassower in just a moment on that. But what a run. They say there's always a bull market somewhere. That's where that bull market is right now. The big banks here in the United States kick off earnings on Friday. JP Morgan goes first, Goldman next week. They're set to kick things off on a gloomier note this week, though, preparing to announce more than 3,000 job cuts as soon as this week. Shanali, run us through it.
Certainly, John, you have a tense week over at Goldman Sachs with a headcount reduction of that size. But listen, we knew it was coming, and it's actually a number that was less than it could have been. At the end of the day, Goldman has grown dramatically, and this number is bigger by the amount in terms of the cuts you're seeing. But let me put this in a perspective for you a little bit, because as we head into bank earnings season, it's a focus here on profit. What levers do the banks have to keep costs under control? And if you look at how much net income has dropped off between 2021 and 2022, if they're estimated to bring in that $11.8 billion of net income that analysts are expecting for the full year, that works out to $239,000 per worker. That is way less than you saw per worker just a year before that at $490,000. So $490,000. So you really have a steep drop off here, not in just kind of the pure employee count. If you look at it there, it's really not even bringing you back down to where you were even in 2020. It's barely bringing you back down to where you were a year ago. But what it means here to make a cut of this size, it makes a big difference to Goldman's bottom line, which is why you're seeing the stock really react positively to a lot of these plans that Goldman is putting out for you.
Sonali, they report next Tuesday, on the same day we hear from Morgan Stanley as well. Bit of a change at the top this morning. Run us through the latest.
Huge change at the top. Jonathan Pruzan was this chief operating officer, was the former CFO. Remember, John Pruzan has been there decades. He was a top deputy to James Gorman. By the way, when you look at the top ranks of Morgan Stanley, now you have John Pruzan gone. About a year or so, Shelley O'Connor, a different deputy, had left. You have the top of Morgan Stanley changing, and therefore the line of succession honing in, puts the eyes very firmly on two particular folks. That is Andy Saperstein, who runs Wealth. That is Ted Pick, who is the king of the institutional securities business. And by the way, the reason this is so fun to watch, John, it is a competitive year, especially from Mr. Pick over there. Watch those trading figures come in. Remember, Goldman has been neck and neck with that business at Morgan Stanley equities that they loved to win out for so long.
Looking forward to your coverage that really kicks off on Friday. Sonali, thank you. JP Morgan earnings just around the corner on Friday. Those two banks we mentioned, Goldman and Morgan Stanley, coming up next week. From financials to tech, you know the story, the job cuts rolling in. Here's what Richard Bernstein of RB Advisors had to say.
This was a sector that was in full-fledged bubble mode for a couple of years. They hired indiscriminately, and now they're feeling the downward pressure on that. There's still way too much talk about, will the old leadership regain form, right? In other words, should you look at this as a buying opportunity in this old speculative leadership? I think that's a very bad sign, because it shows that there still hasn't been full capitulation yet in these sectors of the economy.
I want to continue this conversation with Dan Suzuki of RB, joins us right now. Dan, I think you guys are really leading the effort on this front, and I'm not sure many people have capitulated to your view just yet. So Dan, let's start there. How long do you think it's going to take to unwind the excess that's been built up, not just over the last couple of years, but maybe over the last decade?
Yeah, John, good morning. Clearly, it's going to take a lot longer. I mean, this is just par for the course for how, bubbles deflate. When was the last time you saw a bubble deflate overnight? It takes years to really change the psychology and change the positioning around, how people view these things. I mean, for years, we've been taught that, the hopes and the stories were really all that you had to care about. But now that when it comes down to these points where liquidity is tightening, the economy is slowing, you have to come back to fundamentals and profits. And these are areas where people's expectations are way too high. It's going to take time for those things to change. Clearly, they are shifting, but I think it's going to take, a lot longer, a lot cheaper valuations, and people just stop it, people changing the way, they think of these as, huge opportunities for these stocks. I mean, one way to think about it, a rule of thumb for bubbles is, typically takes, a decade to regain those highs, from the bubble peaks. It took, that long it took 14 years in the case of the tech bubble. It took, that long in the case of most bubbles. So I think that's kind of a starting point for expectations.
And Dan, this is not a new conversation for you and I. We talked about this, that lost decades aren't unusual. They're not unheard of. Do you think we could really be in for one at the index level in the United States for large caps?
I think a lost decade, John, is kind of extreme, at least for a base case scenario. But certainly, as you look at the U.S. relative to pretty much everything out there, it does face a lot of headwinds. I mean, the U.S. is still, probably the only major market in the world that still is actually quite expensive relative to history. And that's very much because of that bubble concentration in those bubble assets we mentioned. I mean, the concentration that the tech-heavy sectors has come down from 50% to the low 40s. But that's, there's probably a lot further for that to come down. And having such a high concentration in those bubble assets, which again are going to take a long time, to regain those highs, it does make for a tough decade outlook, for the U.S. market and the index, which is why, I think that, the real opportunity is people, look to take advantage of these down markets and cheaper valuations overall, is actually go look for the stuff that's actually cheap right now. And that's the further away you get from the bubble, that's where probably the opportunities are. So if the last decade was about disinflation and U.S. large cap growth, and I think the opposite of that is probably going to be the real opportunity. So pro-inflation, international small cap value, those are the things that people should be looking at, to take advantage of for the next 10 years.
So Dan, if you also believe then we're in for a period of structural inflation, not structural disinflation, what does that mean for the 60-40 story that people are still married to? Yeah, I think it presents a tougher scenario for the 60-40. I mean, the thing about the 60-40 is that it was a very good way, an easy way to just have a buy and hold strategy and sort of mitigate risk. So I think that story of just the buy and hold strategy on the 40% that represents bonds, that's not going to be the case anymore. I think you can still take advantage of bonds and duration in portfolios. It's going to be a lot more tactical in nature. I mean, I think, as a starting point, just think back to these periods of higher inflation. There were huge opportunities to be had in bonds and duration, but you had to be very tactical. I think one of those opportunities is probably right now. I think the next year, bonds actually present a really attractive opportunity, as I think that the long end of the curve is probably going to come down as growth slows. But when we start to recover, you're going to want to be out of that trade. And so it's going to be a lot more tactical of a 60-40 going forward. Can I talk to you about the tactical story on the equity side as well? So you've given me the more long-term, sustainable, fundamental story on equities, Dan. What about the near term? So Bank of America had this to say on Europe. We think the next big story for markets will be a sharp loss of growth momentum in response to aggressive monetary tightening. This is not yet priced, with markets buoyed, or buoyed, as you might say, in the United States, by strong activity on easing supply issues, fading gas prices, and China reopening. So, Dan, I get it in the near term. EM's ripped. China's ripped. China reopening, all of that good stuff. The energy story's faded a bit in Europe as well. Give me the tactical story for stocks in the near term, Dan. Yeah, I think the tactical story and theme for the near term, John, is very simple, and it's very consistent with what we've been saying for a while. In an environment where we're just going into a profits recession globally, liquidity is continuing to tighten. I think that's an environment where the number one theme in portfolios right now should be defense. Now there's going to be periods where markets rally, but I think this is probably the worst combination of fundamental factors, to be, pedal to the metal on risk in portfolios. So I think, for the time being, you want to focus on defense. There will be opportunities. There are opportunities today to play offense, but there are going to be huge opportunities, over the next 5 to 10 years, to have huge gains and take advantage of that upcoming bull market. But for the time being, when we're just now entering into a profits recession, I think defense is probably the more important factor. Let's talk about those opportunities in just a moment. Dan Suzuki's going to stick with us. Coming up on this program, China opening its borders and giving EM a major boost.
The China reopening, which we may debate whether it is a global scale event or not, but it's certainly an EM-wide relevant event.
That conversation up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for the subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
China reopening, which we may debate whether it is a global scale event or not, but it's certainly an EM-wide relevant event. You have very attractive valuations and a dollar cycle that has finally turned, coupled with the peak in interest rates. So we all know it's the best time to be overweight emerging markets, both equity and fixed income.
China taking a final step in dismantling COVID-0 and opening its borders. This as officials consider wider budget deficits to ramp up economic support, driving emerging market equities towards a bull market. For more, Damien Sasser of Bloomberg Intelligence joins us right now. EM equities, Damien, ripping.
Yeah, no, exactly. Markets are looking straight through China's let-it-rip approach and basically pricing in the good news after the bad, right? I mean, so I think where we are here is it's tactical. I think, I think people have said it on your show earlier, best. I mean, so I think it's going to be a tactical upside here. We see broad dollar weakness taking hold. We see EM currencies largely led by the Asia-Pac region all rallying, and I'm talking Thai baht. We talked about that just a few days back. It's Korea as well. And so, look, that's spilling into the broader EM equity universe. But, Jonathan, we must remember that the EM equity universe is China, and it's largely four stocks. I'm talking Alibaba, Meituan, JD.com, you know the rest. So, I mean, it's a tech play. And so what are the legs there? In this environment with the U.S. coming into recession, the verdict is still out.
Have you got a final word on Brazil?
So, of course. So,
What
I
do you
mean,
make of that
basically,
over the weekend?
yeah. I mean, look, I actually had a deck that came out. It was good timing this morning about how, basically EM practitioners have gotten used to living with geopolitical risk. And we've seen this now in Peru, Chile, Colombia. We're going to see it in Argentina at the end of the year. Jonathan, this is really nothing new for Brazil. We saw riots in 2013 and 2017. Now, the one takeaway here is this definitely undermines the credibility of the right, basically, in Brazil. And what that means is that Lula's spending caps, he might have a lot more durability to enact a lot more spending throughout the course of his tenure. And so that's bad for the Brazilian real. And I think the real is sort of reacting to that at 5:30 this morning.
Getting hammered. Damien, thank you. It's good to catch up, sir. As always, Damien Sasser there on this massive rally you're seeing in the equity market, in emerging markets. Dan Suzuki of RB Advisors is back with us for a final thought. Now, Dan, if I said rate cuts to people, they'd be frothing at the mouth, maybe, thinking about buying big tech. And I imagine you're thinking about emerging markets in a bigger way. Is that right?
Yeah, I think, I mean, when we talk about emerging markets, I think, I think Damian made the point, emerging markets are so heavily dominated by China, that really drives the story. And if that's the case, I think there is a reason to be more optimistic on emerging markets at large. But for me, I really see a tale of two different stories. Really, you have China and everything else in the world. I mean, pretty much everything else out there is seeing, slowing profits and tightened liquidity. The reason that China specifically is so interesting to us right now is that it's doing the exact opposite of everything else in the world. Just as the world is about to tip into a global profits recession, China is actually poised to exit their profits recession, and at the same time, they're trying to pump liquidity into supporting their markets. And so that's a very, very different story than what global central bankers are doing. So I think a lot of that story is very specific to China, and so I think that's probably the best way to play it.
Is that my new diversification, my uncorrelated asset?
It's definitely one of them, Jonathan. I think, for the last, people haven't really come to terms with this, but over the last, 3 or 4 years, China has been consistently, counter-cyclical. As the world was, entering into the pandemic freeze, China was actually holding up the best. As the world was coming out and surging, on the back of policy stimulus, China was a huge laggard. And now, as the world again is tipping into a profits recession, China is doing the opposite. So I think from that sense, China does make a great area of portfolio diversification today.
Dan, Damien's still with me. I wanted to give him the final word on that. Damien, I think this is such an important point coming into 23.
Yeah, no, I have to agree with one thing that Dan mentioned here. China government bonds, look, they were down 5.2% last year. That's the best performance of any fixed income asset class writ large. Chinese government bonds have been a good diversifier for your sort of core fixed income portfolio. But talking about China bonds and talking about Chinese equities are two entirely different things, right? So Chinese equities, while I take everything that Dan's saying about, margin improvement, about revenues, I mean, it's going to snap back certainly with the COVID reopening, but yeah, there's still a lot of risk in that market. And so, look, I agree with you. You need to have some exposure. 0 is not the right number, but 2.5%, 5%. I mean, it starts to, it's risk, you know what I mean? It's how much you allocate to that risk.
This is the third year, though, of pandemic economics, and it gets extended by China reopening. And Dan, if we can finish there, I think it would be beneficial for all of us. On the demand side, it's pretty obvious to me how this works out. It's obvious to all of us. You get more demand, great, we reopen. On the supply side, Dan, it's less obvious to me whether we get supply chain relief or further supply side dislocations because of that burst in demand. Dan, from your perspective, which one is it?
Yeah, I think it's more the former. I mean, really, the one big, question mark for global markets today is, how fast is the reopening going to be? And if it is really fast, that is going to, do a great service to the rest of the world, because the reality is demand everywhere else is slowing. So there is excess capacity. We're not going to have those supply chain issues if it's really just China that's holding up the world. So I think from that perspective, that excess demand that's going to shield, global, the global economy a little bit, I think that's generally going to be a positive. And I think the supply chain issues, sure there will be some targeted areas. But I don't think it's going to be much more of a positive story, I think
we all know one thing with confidence, that the consensus is going to be wrong on something very, very big, and I just can't work out what it is. Dan Suzuki, thank you, sir. It's good to catch up, buddy. And to Damien Sasser there at Bloomberg Intelligence, thank you. Equities are up here about 23 minutes into the session, up 0.8% on the S&P with some sector price action. Here's Abby.
Yeah, and that gain is important, John, because we're looking at the first 5 days, at least right now, of January being higher. Some say that is a positive omen for the year relative to sectors. Not surprisingly, most of them are higher. Tech is the best, up 1.8%. Discretionary up 1.7%, despite the drag of Lululemon. Lululemon is actually down for a second year in a row, down about 7% this year, in contrast to what we were talking about earlier. Consumer staples and healthcare defense, investors not wanting it. And take a look at the China trade. You were just talking about it. We have the NASDAQ Golden Dragon Index up 1.8% higher with energy. And we also have lots of hope that reopening trade is fully in play there.
Abby, thank you. Stocks building on the gains from Friday. The S&P up by 0.8%. Your trading diary up next.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
This is Bloomberg.
26 minutes into the session, equities advanced by 0.8% on the S&P 500, led by tech with the Nasdaq up by 1.6%, healthcare lagging just a little bit so far this morning. That's the price action. Let's get you the trading diary. Coming up, Atlanta Fed President Bostic speaking at 12:30 Eastern, President Biden meeting with AMLO at 5 p.m. Eastern time, followed by the North American Leaders Summit on Tuesday, plus Fed Chair Powell speaking from Stockholm tomorrow morning. Another round of US claims coming up later on Thursday, and then we get CPI as well, the big one. Then on to Friday is bank earnings in America. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Wiener Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wiener Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world.